you now?
Look, I think obviously this is a train people have gone on, but as Anne-Marie would probably tell you, it's very hard to price that unknown that is coming from the geopolitical risk. I think this is something that investors struggle with. Last Thursday's price action, I think, was a really good example of that, which is, you know, if we get into an escalating situation with Iran, like how do we price that? How do we price these unknown unknowns? Which is why I think that bid continues. And then obviously you have this valuation argument that continues to hold too, which is why I think people continue to stick with that.
When you look at the options pricing, though, we're seeing, at least I'm seeing a lot of people buying 125, 135 calls on oil. How high are people actually expecting this peak in the summer could potentially get?
You know, a good analogy to that, Anne-Marie, is I also see people buying 30, 40 strikes on VIX itself. And the way I would think about it is, do they think that we're going to get there? No. But if we do get there, that payout is really, really attractive. You get that convexity immediately. And I think that's what people are actually saying. They're saying if we get some situation that is unanticipated, we know those tail events are relatively inexpensive. We're getting extremely attractive payouts, and that's what we're playing for.
One thing that I keep hearing from you is that there has been a shift, whether it's with AI stocks, whether it's with just the sort of preparation for downside from this hotter than expected CPI print, which people are anticipating. What does this tell you about inflection points, just based on your history, when you start to see derivatives trading sniff out something that's slightly different?
Yeah, and you know, I keep harping on this, which is that this is the first time the derivatives market has said something different when we've seen momentum go this way, because I think I was here like right prior to March 18th when that NVIDIA conference was, and the one thing I had said then is, look, there are these clearing events where either momentum continues or it stops, and when we see that shift in momentum from the options market itself, that has typically been a really interesting leading indicator, and we have not gotten that. That's the one difference between now and over a month ago.
Deeply thoughtful stuff, Amy. Thank you.
Thank you.
Amy Will-Silverman there of RBC Capital Markets. I don't know about you, but what I heard there was basically economists are looking for 0.3, but the market might be positioned for 0.4.
Which is the reason why if you get 0.2, get ready for a rip-roaring rally because all the shorts are going to get squeezed out. Essentially, this is a unique moment, though, as we just heard from Amy, that this is the first time in recent memory that this is a market more prepared for an upside surprise and the downside that comes with it from the CPI print, rather than maybe a downside surprise.
Which is why we've said a few times on this program, in line might be the new beat when it comes to inflation and the way this market's set up. The way we're set up this morning, equity futures positive by 0.1% on the S&P 500. Let's get you some stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Fitch has cut its outlook for China's long-term debt from stable to negative. The ratings agency says rising economic uncertainties have eroded fiscal buffers. Although Fitch sees government debt increasing in coming years, it did affirm China's A+ rating. There are more signs that Apple is trying to push beyond China. Bloomberg has reported that the company assembled $14 billion worth of iPhones in India in its last fiscal year. That's double the production from the year prior. Sources say the tech giant now makes as much as 14%, or about 1 in 7 of its marquee devices in India. More trouble for Boeing. The FAA is investigating whistleblower complaints that the company took shortcuts to ease production bottlenecks on the 787 Dreamliner. The plane maker says the claims are inaccurate and do not represent the work it has done to ensure the safety of the plane. Shares of Boeing so far this year are down 30%. Scrutiny of manufacturing practices have been building since the mid-air accident in early January. That's your brief, John.
Pretty concerning stuff, let's put it that way. Danny, thank you. Earlier on, I was teasing, promoting that interview with Tom Tedesouris of Strategas. And if you are just joining us, just listen to this line. Washington committed to run the economy at full employment of all costs until the election, and the Fed is looking for every excuse possible to cut to aid this cause. As you said, these are kind of things that people whisper. You know, they have quiet conversations about. The cynical people amongst us, skeptical of the objectives of the Federal Reserve.
Well,
they're saying it out loud.
Well, and Tobin was saying this is an active conversation in terms of policy, and yet there really is this ultimate question: where is the mandate right now on keeping inflation down to 2%? A lot of people are saying, nah, that's squishy. In terms of employment, that's a really important one, and I think that's really where the mindset has shifted.
We'll have an active conversation later this hour. Don't miss it. Up next on the program, the Biden administration taking on China.
China's whole strategy is to isolate the Philippines, isolate Australia with their economic origin, isolate Japan. Our strategy is to flip that script and make the isolated party China.
That story up next, live from New York this morning. Good morning.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need. Like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
Coordination and cooperation on the security stage. But remember, that's a handful of nations. Asia is much bigger than the Philippines and Japan and Australia. There's plenty of courting going on China's side too, and I think it's far too early to say there's any kind of isolation going on. At best, the kind of tangible details that might come out of this meeting between Japan and the US today look fairly modest. It's all about cooperation. There's going to be some additional cooperation on allowing US naval vessels to be repaired or maintained in Japanese shipyards, for example, more coordination around technology and AI and the like. And obviously all about building up this sort of drumbeat of support against China's claims over Taiwan and tensions in the East and South China Sea. But all of that, as I say, that's cooperation and coordination. I think if you're talking about isolating China, that's a whole other story altogether.
But when you look at what they might do in terms of defense, and this comes on the heels of already naval exercises between the Philippines, Japan, and the United States, that was a huge warning sign, really, to China. Is this their diplomatic way of pushing back even more on China, especially in the South China Sea?
It very much is, and there was a White House statement, Anne-Marie, making the point that they want to send a signal that China needs to know where the limits are for its aggression and for its claims in the East and the South China Sea. And those drills, as you mentioned, very unusual with Australia, the Philippines, Japan, US this week, sending a clear signal. And as I say, these talks with Japan today, and then of course the summit with the Philippines tomorrow, that's all about creating this idea, the optics, that there is an alliance, that there is pushback among allies against China's claims in that part of the world. But as I say, China itself does have its own allies in the region too. China remains the most powerful economic force in that region. So it's not like whatever comes out of the talks today and tomorrow is going to result, in China necessarily taking a step back.
Ambassador Rahm Emanuel also talked about this multilateral approach, whether it's defense, whether it's economics. How does the United States do that when the president has come out in opposition of Nippon Steel taking over U.S. Steel, even though Japan says this would be one way to fight China?
Yeah, this is the steel elephant in the room, as my Bloomberg economics colleagues called it. I mean, there's politics and economics here, Anne-Marie, as you know. The economics of it are the U.S. is asking allies to do more to restrict technology into China and to do more to help it in its pushback against China. But here you have, of course, Japan trying to buy that steel plant in the U.S. and the president giving his disapproval of it. It hasn't been blocked outright, but certainly giving his disapproval, which was unusual. Economics of that suggesting what signal does it send about the U.S. attitude towards foreign investment here, and especially among allies. But the politics, as you know very well, are also pretty real too. This is about a very sensitive sector, the steel sector, in a very sensitive electoral state, Pennsylvania, in a very important year, which is the election year. So there's no doubt that politics has obviously trumped what is going on here. The question remains is how much wider damage does it do to the U.S. standing in kind of the world of free trade. Chinese state media are certainly dining out on it, but there is also a view that this will be looked at through the political lens. So Prime Minister Kishida, for example, he has said he doesn't plan to raise it in his talks with President Biden today.
We started by talking about the concept of isolating China and how it's probably being received. Some of Rahm Emanuel's more fiery words than, say, Janet Yellen. I am curious about the economics of this at a time where you see Apple just quietly shifting production out of China and into India, at the same time that they don't really sell in India because India is flooded with cheap Chinese phones that really dominate the market. How much has this become part of the issue for the United States that China is flooding the market globally with cheap goods that it wants to sell, not just to the U.S., kind of crowding out competition elsewhere?
It seems to have become the topic of the moment. The main theme, the main messaging from Secretary Yellen's trip to China last week was all about the idea that China is making too much excess produce, and it is, as you mentioned, Lisa, dumping it on global markets at cut prices. And interestingly, during that speech, during that visit, Janet Yellen made the point this wasn't just a threat to U.S. factories and U.S. workers. She made the point it was a threat to workers around the rest of the world too, so trying to drum up that support. We do have, of course, the big IMF World Bank meetings here next week when finance ministers from every corner of the world will be in Washington, D.C. And it will be very interesting to see then what kind of support, which countries do weigh in behind this US-led complaint that China is now stoking a kind of a new China shock with this export of its excess capacity to key markets around the world. So far, at least, I think the argument hasn't really lit up or taken off globally. It's mostly US-led complaint against China, but we'll see if that changes next week and in the months ahead.
And it also raises this question of whether countries have to choose alliances, whether to go with the United States in this concept of avoiding goods that are cheaper, but from China in order to get in good with the United States, or whether they can kind of just all move to their own music, and if they want cheaper goods and import them from China, go for it.
Well, this is the big economic trade-off. I mean, there's no doubt that China has, of course, been a source of cheaper labor, cheaper manufacturing, lower environmental standards. That's why the world's factory base ended up being based there. And at the flip side, consumers ended up with cheaper clothes, cheaper goods, factories bought cheaper steel, you name it. And I think when it comes to making choices, countries, especially in the global south, to use that term, they're not in the mood for making a choice between either the US or China right now. They're happy to do business. We saw those comments last week from Argentinian president to us, making the point that companies will continue to do business with China as they so wish. So I think if you're looking through this in a binary lens of are you with the US or against them, at least on the economic front, I don't think it's not yet how it's playing out, that's for sure.
Totally missed the boat. And there's something about this that just seems so stale to me over the last week. There's nothing fresh, nothing new in this whatsoever. And let's just dissect the language again. China wants to isolate Australia. They want to isolate Japan. We want to flip the script and make China isolated. Now, do you remember TPP, Trans-Pacific Partnership? Who did that include? Japan, Australia. Who didn't include? China. Wasn't that the whole plan 8 years ago? And are we just trying to sort of refresh that all over again?
Yeah, quite right. There is a lot of repetition and on a loop in a lot of this, John. And it's also true, by the way, of the overcapacity debate. I mean, you mentioned the point of the TPP. That was sold by the US administration at the time as a kind of a grand bargain to build this big trading network in the Asia-Pacific, of course, without China. That was discarded by President Trump. And here we are today. I think by all accounts, if you look at what's happened over the past few years, China has grown its export base. It has grown its economic trading clout around the world, and it certainly continues to court, as I say, the global south. Remember that BRICS expansion last year? So even as the US build its alliances and as it puts on today the portrayal of the alliance with Japan and the Philippines, China too is building its own alliances through its own trading networks, be it the BRI, be it the BRICS, be it whatever else. So as I said earlier, it's not as simple as saying China's being isolated. They're continuing to build their alliances too.
Well said, Ender. Good to catch up with you. Ender Curran down in Washington, D.C. Of course, the former President Donald Trump blew up TPP when he came into office. There's nothing new about any of this. What's new? What's new? Hardly anything. I'd say 8 years ago, what happened? The electorate said no. And they said yes to Donald Trump. And ultimately, no one can campaign on these issues anymore going into November.
It's why this Nippon Steel deal will likely get blown up, especially ahead of an election, which is why when I talk to people, they're saying maybe we're not going to get any sort of consensus on what to do with this deal until after November 5th.
Strong words, but sort of back it up with policy. What are you doing about it?
And that leads us to the expected tariffs that are probably going to come before the election and other things. Again, how much daylight is there between the two views of the two candidates, and how do CEOs get ahead of something that seems almost like an inevitability?
Yeah, maybe not much. Coming up on the program, ByteDance's profits surging roughly 60% in 2023. Mandeep Singh of Bloomberg Intelligence up next.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera. And I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
I imagine in about 60 minutes and 30 seconds, this board's going to look very different when CPI drops and people start to actually do things. Equity futures right now on the S&P positive by 0.1%, totally unchanged on the Nasdaq, and we're positive by 0.25% on the Russell. If you switch up the board and get to the bond market, we've had some price action there over the last week, for sure. Got very, very close to 480 on a 2-year. We've backed away since then to about 473.44 on a 10-year, around 440 for a heartbeat, couple of seconds, back down to about 435. 434.97 this morning, down a single basis point. Perhaps encouraged by what's developing on this board in commodities, Brent and WTI, just pulling back from the highs of the year. Brent crude back below 90, Lisa, 89.97.
A bit more of a sense of ease maybe in the Middle East in terms of maybe some sort of resolution or a lack of an Iranian escalation akin to what people had been thinking. That said, there is a new bull bet, and we have been talking about that extensively, where the new consensus trade, some might argue, is with commodities and oil in particular. And if that's the case, how much does this really have fuel to go further, especially if there is some sort of disruption?
Went through all the calls, and this bull bet is pretty clear. Overweight commodities, Marco Kalanovic, Mike Wilson, Morgan Stanley, overweight energy, Lori Cavacina overnight, sticking with energy. Can we just talk about the Middle East? Is quiet bearish? Because what we've got is silence, a bit of quiet over the weekend. I think going into the weekend, what are we waiting for? A response from Iran. Really sort of gauge the prospect of direct confrontation between Israel and Iran and the prospect of that spreading across the region. Because it's been quiet over the last few days. I think crude sold off a little bit, but it's quite constructive. Don't we still have in front of us the very real prospect of confrontation between those two countries?
Absolutely. In the last 48 hours, Netanyahu has come out and said he has a date in mind and when he wants to go into Rafah. So the past 48 hours, we also have seen, though, humanitarian aid go in. Potentially that's giving people some ease, oil pulling back. But this story is far from over.
89.92 on Brent. Positive this morning, at least, by 0.6% on WTI. 85.73. Under surveillance this morning, just under an hour away from the US CPI report following hotter than expected prints to start the year. The median estimate in Bloomberg's survey calling for a 0.3% monthly rise in core CPI. That's a slight tick down from a month ago. Now, you've got two things going on here. The survey, the median estimate in our survey, and what we priced for. And Lisa, I think you've done a pretty good job over the last 90 minutes or so explaining the difference between the two.
Basically priced for an upside surprise, more around the 0.4%. The idea that likely this inflationary story is a bit stickier and the Fed's going to have to push back when they cut rates first. Here's the question, right? Does this basically set up the market for a much bigger reaction if we get a downside surprise or even an inline number than we would otherwise expect? Bonds ripping, stocks ripping, or are we looking at, if we get that 0.4%, the narrative shift that we heard from Amy Wu Silverman that could be a real pivot point?
If we do get, though, within expectations, I love Stephen Stanley overnight at Santander because he brings up Governor Waller's point that they're going to need 2 consecutive months of that benign inflation story to potentially consider cut, and that gets right up to the June date. So what he's talking about, a lot of analysts are now starting to really spin the results. This idea of 0.3% month over month is basically good, even though we'd have to see that again before the Fed considers.
This is why it's lose-lose. Tobin Marcus said this over at Wolf Research in the previous hour. This is why it's lose-lose for the Fed. If they have to wait, they get accused of waiting too long. They go too soon, they're too soon. If they're too close to the election, it's politics. If it's after the election, they're against the person who was running and didn't win. Like, this is the problem, repeatedly.
Okay, well, I'll take it a step further. Basically, if they're doing an okay job and there isn't anything dramatic to talk about, people need to do something with their day all day long. So you've got a bunch of smart people who are overanalyzing themselves into a tizzy and trying to figure out every which way that they can spin it that is potentially problematic and critically thought. So to me, that's also what's going on. To a degree.
It is CPI Wednesday, and that happens a lot. Let's talk about Delta. Shares of Delta rising in the pre-market. The airline reporting first quarter earnings that topped Wall Street estimates. Delta also coming out with strong guidance for the second quarter on the back of increased business travel and steady leisure demand ahead of the start of summer. That stock is up by close to 4%, and Lisa, some pretty strong words coming from Ed Bastian, the CEO.
Basically coming out and saying that they don't see any end in sight to the demand, and that frankly, even though you typically do see a lull in terms of travel ahead of the summer, you're not seeing that. The fact that for second quarter, they're expecting the higher end of the estimates, just to me indicates both the strength in the underlying consumer, but also what we were talking about with George Ferguson, the bifurcated consumer, the fact that the people at the front of the bus are doing pretty well, the people at the back kind of pushing back.
And it's the people at the front of the bus, front of the plane, maybe it's an Airbus, front of the plane that is basically propping up all of this when it comes to the revenue and profit that this airline is making, and potentially with, we see United Airlines and American set to come out, their stock being pushed higher by this. Probably similar stories.
It's been the trend for a long, long time. Let's talk about who's making money. It's ByteDance, reporting a profit surge of roughly 60% last year, underscoring the strength of the social media app. The company facing an uncertain future in the US, though. As you all know, the House passing a bill last month to ban TikTok unless ByteDance sells its prized asset. Joining us to discuss is Mandeep Singh of Bloomberg Intelligence. And Bramo's going to do a little dance for you in a moment. She was doing that off cam as we're introducing that segment.
It was really good.
It was
new TikTok
fantastic.
star.
Okay,
Fantastic. Mandeep, strong numbers from ByteDance, strong numbers from Taiwan Semi as well. Decent numbers out of Asia when it comes to tech. What's behind it all?
Well, so different story. I think in the case of ByteDance, probably it's the strength of their domestic app and, you know, how the ad spending is probably bouncing. I don't think it has to do with the TikTok US business as much as it has to do with the domestic business. In the case of TSMC, it comes down to, you know, every AI player, when it comes to fabless chip makers, has to go to TSMC, and they have the pricing power, and I would say they haven't flexed it as much as NVIDIA has on the actual chip that they are selling. So in the case of TSMC, they've talked about a 50% CAGR for their AI business over the next 5 years. So here's a company that every hyperscaler would go to, every fabless chip maker, whether it's Apple, NVIDIA, AMD, they have to go to. And I think you have clear kind of line of sight in terms of how this business could grow 50% over the next 5 years.
So as you know, TSMC has a working relationship with NVIDIA and with Apple as well. Can you read into these numbers overnight and read into strength elsewhere as well? Can you look at Apple and say, actually, maybe things aren't too bad?
So in the case of Apple, yes, I think it bodes well for a refresh cycle. We still don't have clarity on what they are doing on the AI side. A lot depends on what they announce in June. But clearly, the data center spending is holding up very nicely. And when you look at the numbers that Google and Amazon and Microsoft have talked about in terms of their CapEx going up for this year, that all is going towards buying NVIDIA chips as well as going directly to TSMC to make their own chips, which is what Google indicated yesterday at the Cloud Next event.
There's a sort of larger question here that was introduced yesterday when Intel came out with the proposed idea of another AI chip, which is how saturated is this market? Is this something that NVIDIA can dominate and others can grow? Or is the entry of new players potentially problematic?
Well, so right now I can tell you the market is supply constrained, and we have gathered that from a number of participants who keep saying NVIDIA chips are still in short supply. The H100 and the A100, forget about the new line that they are coming up with. So clearly, given the supply constraints, I would say this year you're not talking about Intel making a dent. And if Google is making their own CPU, that's going to hurt Intel. Intel is the dominant player when it comes to the CPU market, the traditional CPU market. So if every hyperscaler is making their own CPU, that hurts Intel, that hurts AMD. It helps the building block companies like ARM, like Broadcom, like Marvell, but not the chip makers in the CPU space.
With TSMC, how much of a clutch do they have? I mean, we've talked about possibly diversifying away from Taiwan and being able to see production in other places. Is that just not happening because TSMC is so dominant in doing the job that they're doing?
They are, and they are diversifying. I would argue they've started a new fab in Japan. That's live. It's actually manufacturing chips. So clearly, I think that diversification play is happening, albeit in the US, it's still slow. They announced a new round of funding from the CHIPS Act. So clearly, I think they still have the secret sauce when it comes to the advanced node manufacturing. Intel, they touted, the performance of their Gaudi chip yesterday, but they haven't announced a large company that's buying chips from Intel for training and inferencing in AI. That's the proof point that Intel needs to give to convince investors, okay, they're right up there with competing with NVIDIA.
Mandeep, I like to talk about ByteDance, where John started, just because this is the first time it's overtaken Tencent when it comes to revenue and profit. And you look at the US business, this e-commerce business that TikTok is trying to grow. Yeah. They want to grow it tenfold. This is going to be very lucrative, but how existential is it for ByteDance, given all the politics around TikTok?
Well, I would be very surprised if TikTok is able to get into e-commerce in that big of a fashion under the current ownership with ByteDance, because you're talking about, capturing a lot more transactional data, and I can't see, regulators allowing that to happen.
But what's there now stopping it?
Well, I mean, they have to build a delivery business. So think about how Amazon goes about fulfilling the e-commerce side of things. They have their own logistics arms. So TikTok doesn't have anything like that in the US. They have to partner with somebody, a large e-commerce player or a large delivery player. And for that to happen, I can't imagine any company announcing a partnership with TikTok, given they're still owned by ByteDance.
Maybe they'll have to wait till after November. But it sounds like what you're saying is that there's now a ceiling, really, on how much TikTok could grow.
In the US. Outside the US, they've got a number of apps that continue to see very healthy user growth. They are doing very well, domestically in terms of the ad business. So clearly, when you look at companies like ByteDance, you have to do a sum of the parts analysis and look at, how each of the app is contributing to the overall business.
Hey, Mandeep, appreciate the update. Thank you, sir. Mandeep Singh there of Bloomberg Intelligence. Equities at the moment positive by 0.1% on the S&P 500. Inflation data 50 minutes away. Let's get you some stories elsewhere. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. At least 3 people are dead after an explosion at a northern Italian hydropower plant owned by Enel. The company said a fire had impacted a transformer without providing further details. Enel, Italy's largest power supplier, shut the plant down immediately for safety reasons, but local power supply was not affected. Atlanta Fed President Raphael Bostic still sees just 1 rate cut this year, but says he's open to changing his outlook if economic conditions change. Gave himself full optionality, saying that the U.S. economy continues to show resilience, so he can't discount the possibility that rate cuts have to move further out. But Bostic added that labor market pain would mean cutting sooner. BMW sales of fully electric vehicles jumped 41% in the first quarter, outperforming rivals Tesla and Mercedes, and contrasting with a broader slowdown in demand for EVs. Mercedes reported EV sales that fell 8% in the first quarter, while Tesla recently reported its first year-on-year sales drop since 2020. EVs made up roughly 15% of BMW's total deliveries last year, with that figure expected to rise to 20% in 2024. And that's your brief, John.
That's a rare piece of good news. Danny, thank you, because it's been bad news in that space over the last month, that's for sure. I've been sharing this quote with you all morning. It comes from Strategas and Tom Titsouras. Washington committed to run the economy at full employment at all cost until the election, and the Fed looking for every excuse possible to cut to aid this cause. Up next, the Fed getting pulled into politics.
If they cut in June or July, they'll be criticized for cutting too early and too much. If they cut in September, they'll be criticized for cutting too close to the election. If they wait until November or December, they'll be criticized for holding rates high, sort of longer than necessary in a way that hurts Trump.
That active debate up next.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The deal?
The Deal.
The deal.
That deal.
The deal.
Huge deal.
Who dug this up? What are y'all in trouble?
Wow.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
DOJ or other authorities.
Could face bigger challenges next.
Was going to keep Green World Cup. This is a 3
As the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
"46 minutes away from CPI data in America. You know the numbers by now. Looking for an estimate, 0.3%. That's your estimate in a median survey, median estimate in our survey here at Bloomberg. The previous read, 0.4. Equity futures positive by 0.1% on the S&P. Yields a little bit lower by a single basis point on the 10-year, 434.77. Under surveillance this morning, the Fed getting pulled into politics.
Powell's very clear political incentive is to ride off into the sunset as the person who defeated this outburst of inflation. If they cut in June or July, they'll be criticized for cutting too early and too much. If they cut in September, they'll be criticized for cutting too close to the election. If they wait until November or December, they'll be criticized for holding rates high, sort of longer than necessary in a way that hurts Trump. So he's damned if he does and damned if he doesn't, I think, in terms of the political incoming he's going to face.
Here's the latest this morning. Less than 1 hour away from the March CPI report, investors looking for insight into the Fed's path forward following hotter than expected inflation prints and some pretty strong job numbers. Tom Titsouris of Strategas, a Baird company, writing this: Washington is committed to run the economy at full employment at all cost until the election, and the Fed is looking for every excuse possible to cut to aid this cause. Tom, we've been looking forward to this all morning. Good morning to you.
Good morning. Thank you for having me.
What tells you, that last line, I think this is really important, what tells you the Fed is looking for every excuse possible to cut to aid the cause of the White House?
Well, because simply put, we're still at full employment. Inflation is still well away from target. And the Fed is already talking about rate cuts, penciling in 3 cuts for the full year. And on the speaking circuit, you're having Fed leaders talking about rate cuts, the need to slow balance sheet reduction. All of that is indicative of a lean towards wanting to ease sooner rather than later.
Do you think that's a mistake? Possibly.
Well,
why is it a political bias?
Well, it's definitely a mistake if we continue to be at full employment and we continue to miss on the inflation mandate, because simply put, it's unprecedented to be easing this aggressively when you're already at full employment and inflation is already too high. So by definition, that's a policy mistake. But do they know something different, or is it a political bias? We don't know that right now. We don't know if they are seeing something that's making them very concerned. They could be concerned about financial stability, which is not necessarily politically biased in general, but has political ramifications. So there's a lot that they could be seeing that's worrying them that is not necessarily a political bias, but it's very suspicious at this point.
Okay, so to be clear, you hint out that this is sort of a political bias because you can't find the justification in the data. Is that basically your conclusion?
Yep, that's what we have to conclude. That's the most simple conclusion. Now, as I said, there's another possible conclusion here, that we have a Treasury deficit that is just gargantuan and is going to become progressively more difficult to digest. That causes not just political consequences, but financial instability. So we know very well that as the reverse repo facility shrinks towards zero and T-bill issuance ramps up again later this year, you're going to start pulling money out of bank reserves. If the Fed doesn't ease into that, there's pure liquidity drain. You can't run $2 trillion deficits year after year, even if you're the world's reserve currency. So there's a financial stability risk here that could be motivating the Fed as well.
I love this. You're saying all the quiet parts out loud. Number one, potential political motivation by the Federal Reserve or political bias. And number two, this potential that the deficit is hanging over their head and they want to ameliorate some of the interest payments. What about this argument that you are seeing real pockets of weakness in particular segments of the population, that you are seeing small business confidence coming in at the lowest level going back more than 11 years, that you are seeing delinquencies pick up, that you are seeing certain segments really hit hard with rates where they are?
Oh, I agree with that, and that's why they shouldn't have raised rates the last 50 basis points. They should have run off the balance sheet at a quicker pace, because what you're doing is you've seen the Fed squeeze the life out of Main Street USA by raising the Fed funds rate. But part of the reason why inflation has remained persistent is because they have not used the balance sheet aggressively enough, and the world's largest spender, the U.S. government, has not seen any constraints on it. If they had used the balance sheet more aggressively, there would have been less strain on Main Street and more strain on the big spenders.
Hold on a second. You're saying that they should have disciplined the government by not necessarily helping them?
Well, they should have recognized where the inflationary pressures are coming from, where the excess aggregate demand is coming from. It's coming from high net worth individuals. It's coming from mass affluent households. It's coming from government spending. And so the way to rein that in, to keep that inflationary pressure from continuing to push the economy beyond full employment, is to put upward pressure on those borrowing costs. What the Fed has done has put upward pressure on Main Street USA, small businesses. I like to use the stereotypical grocery store owner. They've seen bottom-up pressure from insurance costs, energy costs, costs of goods sold, and bank lines of credit. They carry their inventory with bank lines of credit. They've seen it go from 3% to 10%. Pure bottom-up cost pressure for these guys. If you look at large companies, if you look at the federal government, they've seen their borrowing costs rise 200 basis points, maybe. They maybe in some cases have gone negative. You look at large cap tech companies that actually have negative net interest margins, I should say positive net interest margins. They're looking at negative borrowing costs on net. So there hasn't been enough tightening there.
Tom, what do you think is more important than fiscal policy right now or monetary?
Well, in terms of the labor market, fiscal policy. So we're looking at stimulus coming out again in 2024, very likely targeted towards the middle to third quarter of the year. And that's more important for the labor market because, simply put, it's designed to keep the consumer spending. When you're talking about financial markets, obviously monetary policy is what's most important. But monetary policy, too, is being blurred by the enormous amount of cash the Treasury has and has been slowly pumping into the economy. So right now we're actually in we'll call it a liquidity air pocket. As households and businesses pay their taxes, folks are pulling bank reserves, they're pulling their money market funds, they're selling their muni bond funds to pay the government. That's pulling liquidity out of the market. That's one reason why we've seen the equity markets off and you've seen bonds off. But as that results in a cash hoard by the Treasury that is later going to come out this year, liquidity will matter. And if the Fed eases into that Treasury cash push, you're looking at essentially an ocean of liquidity coming into financial markets from, we'll say, May until Election Day.
If we could talk about the election, this idea you have that the Fed wants to aid that course of what we're seeing, potentially keeping Biden in the White House, how much consensus does Powell need if he wants to make that cut?
Well, first of all, I'd stop short of saying they want to keep Biden in the White House. I think they want to keep financial stability for many reasons, one of which is it creates political stability. But I think their primary motivation is still financial stability. I don't think they care about one winner of the White House or the Senate or another. They want the stability that comes with a stable Treasury market. Unfortunately, that has huge political ramifications. So I do say that, and I forget the second question. So,
well, how much consensus does Powell need? Because the stakes are very high, and it is going to be seen for many people through the lens of politics.
Well, that's a great question. How much do they need? How much proof do they need? Well, they've already got proof that they haven't tightened enough, that there's still too much inertia to inflation. So how much more proof do they need? Will today's CPI give them proof that they cannot cut 3 times this year? It should, if that comes in hot. So I do believe that if we get a hot CPI, if that comes in, let's say 3.5 on a year-over-year basis, 0.4 or higher month-over-month, that should take that June rate cut off the table. But just as importantly, that should take an announcement for a May taper, or starting in June, off the table as well. That should be enough. To me, that should be enough. But I don't know if that's enough for the doves in the Fed to continue to pull back and say, okay, we got to wait another month or so. But that to me should be enough. That should be enough for Powell to say we have too much inertia to this inflation still. It's still too sticky.
Tom, are you saying they're willing to trade price stability for financial stability?
Unfortunately, I do think if there's been one casualty of the Fed over the last decade plus, before I'd stop short of saying their political independence has been sacrificed, but I do think their focus on dual mandate of full employment and price stability has been sacrificed because of an excess focus on financial stability, which oddly enough is not one of their legal mandates, and two, is probably the least achievable of these sort of philosophical mandates. They really can't achieve financial stability, but there's been such a laser focus on it from a regulatory standpoint to simply a monetary policy standpoint, keeping financial markets stable.
These are some big statements, and I'm sure you understand that. So if the Federal Reserve is willing to do that, not for me to challenge, that's your belief. You also believe that Treasury supply could become a financial stability risk as well, a global financial stability risk. Can you tell me what on earth to do with Treasuries right now? Because if I was listening to this, I'd really be struggling. What do I do?
Well, we wait for the CPI number, because that is going to tell us which direction the Fed is going to go in the next few months. But more importantly, it's also going to tell us where is nominal growth going to be, and that's a good benchmark for 5-year and 10-year treasuries. So that's the first point, I'd say. But what do you do with treasuries? You do what you have to do. Treasuries are the gold that backs up the global financial system. You can't really liquidate them completely. So you've got to hold them, whether you're a bond fund, you're an equity fund, you're a bank. So you can't migrate away from them entirely. So you've got to be tactical right now. We're in an environment where, depending on your mandate, depending on what you do, you have to hold treasuries, but you don't have to hold duration. So you can leg in and out of duration, increasing duration when the market gets sold off. And when we start to see 5- and 10-year treasuries approaching where nominal growth is trending towards, that's a good buying opportunity.
So keep buying the dips is the trade ultimately. Yep. Okay, Tom, thoughtful stuff. Controversial at times as well, a lot to talk about. Tom, thank you. Tom Tetsuras there of Strategas with some big calls, Lisa, in this Treasury market.
Basically talking about why this Federal Reserve wants to cut so badly and how much this has really raised questions about what could be behind that in terms of motivation. In terms of the conclusion for the investment thesis, I wonder how much Tom is on the same page with Bob Prince of Bridgewater, basically saying just kind of not cash, but short-term treasury is kind of what's the motivation to leave that if you're getting yield, unclear exactly when they're going to go lower, and, risk off.
The big hour is up next. Here's the lineup for you. Lisa Shannon of Morgan Stanley, James Steele of HSBC, Steve Risciuto of Mizuho, David Kelly of JP Morgan. Steve and David have very, very different views on what this Fed should be doing and how they view incoming inflation data. That's all coming up in the next hour.
I am so looking forward to another face-off. David, though, talking about this disinflation, how it's real, Goldilocks. Steve Risciuto saying, kind of more on the same page as Tom.
CPI just around the corner, 34 minutes away. Equity futures positive by 0.1%. The scores in the bond market look a little something like this. Your 10-year yield lower by 2 basis points to 4.34. The 2-year down a single basis point to 4.73. The third hour of Bloomberg Surveillance up next. CPI just around the corner.
Ask you about politics. You've been involved advising presidential candidates, and I presume presidents as well. You ever have any interest in serving in a senior position in the federal government or running for office?
Absolutely, unequivocally, no.
The aggravation factor isn't worth it?
It's the aggravation factor, but it's more importantly is I don't believe there's any integrity in it.
So you do give money to politicians, though, because that's the system, but you...
It's part of the game. I think, to be honest, I think there's a need for a multi-party system in the U.S. to give more people a choice about where they can throw their voter support and their political support, but also to cause the country to sort of come together by having everybody have a role in deciding what is in the long-term best interest of the country. I've often believed that Black Americans as a people and as a voting bloc should adopt the same position that the original founders of the Congressional Black Caucus had in early 1970. Their philosophy was enunciated like this: Black Americans should have no permanent friends, no permanent enemies, just permanent interests.
The top names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
We're in an economy that still has a lot of inflationary pressure.
I would not assume that inflation numbers would be super sticky, but they would certainly be bumpy.
We are still looking for disinflation to continue.
We're talking about inflation behaving, okay? We're not talking about inflation accelerating.
Inflation will be sticky. Inflation will be absolutely sticky. And I do think that that actually warrants, over the long term, the Fed rethinking its inflation target.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Here we go. This is what it's all about. Finally, the boredom's over. The third hour of Bloomberg Surveillance begins right now. Inflation data 30 minutes away. Live from New York City. Good morning, good morning. The estimate in our survey, 0.3%. The previous number, 0.4. If it's 0.4, repeatedly, that's been called a bump in the road. Are we going to get another bump in this road? Chairman Powell with this to say recently. Too soon to say whether the recent readings are more than just a bump.
And maybe we get a sense of how the market is shifting, because it does seem like there is some sort of inflection point, as we were talking about before the data. I just want to make a little correction. It has been thrilling over the past 48 hours. Sure. We have gotten Treasury auctions. We've got Delta earnings. Market's done nothing. Yeah, and that's basically where we're at. Because
you
basically,
want to get to the market board?
Because no one can really get any ahead of this based on the fact that we don't have an understanding of the Fed, the reaction function. We don't have an understanding of an economy that is utterly the most confusing thing I've ever heard.
Let me capture Lisa's excitement for you. Let's go straight to the market board and look at equity futures, which are positive 0.16% on the S&P. Yesterday, I believe, on the S&P 500, we were positive by 0.14%. I think on Monday, we were negative by what? Not even a tenth of 1%. I mean, just shocking. Huge moves, AMH. Massive moves to get your hands around.
At least Lisa had Delta this morning, which actually is moving in pre-market. When it comes to inflation, I'm actually looking forward to this hour. After the number, David Kelly versus Steve Risciuto once again. I love David Kelly's note. It was a little bit of a humble brag. I'm still running marathons. And when he's talking about talks about it, what it means for monetary policy. In short, in long distance running, one key is to make decisions, but four, it feels like you need to. Does that print today support that in terms of the Fed cutting before others say they need to?
Nothing humble about it. I just want to say that's not exactly a humble brag.
I've lost count of how many marathons that man has actually ran.
Good for him. I think that's wonderful.
I think depressing for the rest of us. 28 minutes away from that inflation number. The scores in a bond market, yields lower by 2 basis points on a 10-year, 4.34. Coming up this hour, Morgan Stanley's Lisa Shallett on her no-landing outlook. Mizuho's Steve Rasciuto on why rate cuts aren't guaranteed. And JP Morgan's David Kelly on why the timing of cuts is crucial. We begin with our top story, CPI data just around the corner. Morgan Stanley's Lisa Shallett saying this: inflation has remained sticky. For the Fed, the hotter than hoped for data is not simply a risk to its inflation and employment estimates. Rather, it shines a light on its long-held bias towards cutting rates. Lisa joins us now for more. Lisa, good morning.
Good morning.
Where does that long-held bias to cutting rates come from? What's it all about?
So look, our perspective has been that for a long time, they've been really focused on managing liquidity. We know, as some of your prior guests this morning talked about, liquidity has begun to finally drain out of the system. You know, this has been a 2.5-year period where financial conditions have remained extraordinarily accommodative. And I think that they want to cut so that they can get to QT, the tapering of QT. They've tried to keep, quote unquote, an order to things. And that's what this is really all about, is them managing liquidity in the economy, this idea of ample versus abundant that they keep talking about. They don't want to have a Christmas 2018 correction in this market.
Are financial conditions tight or easy? I don't know. Deutsche Bank's Matthew Raskin put out this question. If financial conditions are this easy, is Fed policy that tight? Are we easy, tight? Where are we?
We are 100% easy. You don't see markets like this. You don't see credit spreads where they are. You don't see auctions going off without a hitch unless there are easy financial conditions.
That said, they are tight for some people, which is what we heard from smaller businesses and what we hear when we look at delinquencies on credit cards and things of that nature. Have you ever found the economy this confusing?
No, I mean, I think one of the things that has happened, and we can maybe trace it back as long as, the past 15 years of what zero interest rates have wrought, which is an extraordinary divergence between the haves and the have-nots, right? So when you think about it, for, the wealthier, 40% of the economy, high rates are actually income producing, and that's been stimulative. Right? For the folks who actually need credit, it has been a headwind. And I think that divergence is getting bigger and bigger and bigger, which is why, peeling apart and decoding the economy here is tough, right? Because if you actually look at consumer confidence in the aggregate, it looks like it's drifting up. But when you look at consumer confidence by income cohort, right, the lower 2/3 are actually suffering and saying, hey, there's inflation, there are higher rates, my credit card payments are going up.
Which goes to sort of what do you do from an investment standpoint, given the fact that the Fed has to make a choice. Do they try to curtail some of the gains in markets, or do they try to sort of throw a bone to some of the lower income sectors who are really struggling? If they err on that side and they cut rates, are they just going to turbocharge what's been benefiting the upper class for the past, year, but also longer than that?
Yes, yes, and yes. And I think that that's why they've backed themselves into a corner. I think that this lack of stability is going to be with us for a while. And I don't think that they have a clear strategy for how to manage it.
Some words and phrases you've used: vigilance, maximum active management, reduced exposure to the US consumer, discretionary. Walk me through why. Why do you think margins are going to be challenged sometime soon?
Yeah, so if we peel things apart, the overall margin expansion of the Mag 7 last year was spectacular. It actually really drove the aggregate market cap weighted index, rebounded margins. Underneath that, margins are basically where they were pre-COVID, which suggests we're quote unquote normal, but we're not, expanding yet. And the question that we have, for that cohort, the non-Mag 7 cohort, is really where is margin expansion going to come from? It looks, based on the inflation data, like costs are going up. Manufactured input costs from the ISM manufacturing are going up. We know the PPI has been going up. So that's a pressure. It's not at all clear to us that while we may say that wage growth is decelerating, it's still over 4%. And so our basic contention is without a lot of top line growth in this economy, which we may get for some cyclical sectors, it's going to be hard to get margins really going here.
You went there. Can it be made up with better top-line growth? And ultimately, is there a better way to play higher nominal GDP in America? Is there a better way to play it outside of the consumer?
Yeah, so our contention has been that the best way to play what we're seeing right now, which is a rebound in global growth, a rebound in manufacturing-based growth, is with cyclicals, industrials, energy, materials, even financials, potentially away from some of the more general retail or consumer discretionary names.
You also point to the fact that there actually are more upside surprises coming from outside of the United States, and that kind of shift has kind of caught your attention. Are you liking emerging markets in areas that typically are more leveraged to a more positive cycle, even though we might not be heading toward one?
Absolutely. I mean, I think one of the things that we spend the most time educating clients on right now is the extent to which we're seeing all-time highs outside the U.S. Telling them the story about what's going on in Japan, telling them the story about the rebounds in industrial production data in Germany, right? After, Germany's kind of languished for the last 18 months. It's an interesting story, and European markets have responded, and we think that there's more juice in that lemon, as they say, and emerging markets as well. Even China, as negative as people want to be on China, it does look like there's a little bit of, improvement on the margin that's positive.
So just to sort of give this perspective, are you moving more heavily into Europe, into Japan, even into China, and out of the U.S.? Is that kind of the way you're playing this?
We are trying to rebalance, and we're trying to be diversified. That's part of the aggressive active management, is let's be maximally diversified, and let's take advantage of some of these emerging trends, which includes not just moving by sector, but moving by geographies.
You mentioned China. You're touring, or is it a destination?
China cannot be a destination for our clients right here. I just think the volatility of policy, the volatility of geopolitics is too high. And so we've really been favoring a EM ex-China perspective, where we think that there are good opportunities in places like Mexico, Brazil, India, for example.
When you look at also, you're talking about infrastructure, industrials, energy. What exposure exactly? Is it the companies you like, or do you actually like some of these materials?
So we are owning both, right? So we believe that inflation's going to be stickier. We've owned the underlying commodities. That's been a decent trade, and we think will remain a decent trade so long as global growth is improving. But we also want to pick companies that are going to beat earnings estimates, right? Given where valuations are, it's our perspective that the only way this market keeps going is that if you have that earnings achievement and earnings surprise, where are the expectations most benign, right, or not stretched? It's actually in some of these more cyclical sectors where people weren't betting on acceleration in GDP, and that's been the surprise.
90 minutes until CPI. How are you going to play this?
We can't kind of play a print. Our best guess is that it's been telegraphed that we're going to see yet another acceleration in the 1 month, 3 month, and 6 month inflation prints. 3.4% headline looks about right to us. And our guess is that the market, again, you talked about how boring it's been, is positioned for that number. I don't think we're going to get a hotter number than that, but we'll have to see.
Lisa, love it. It's great to see you in person.
It's great to see you, Jonathan.
Fantastic.
Lisa,
I've missed
great
you.
to see you guys.
Thank you so much. Lisa Shallett of Morgan Stanley. Just before we move on, just want to issue a quick correction. We had a full screen graphic, TV speak, on the screen a little bit earlier, and it was attributed to Francis Donald of Manulife. It should have been attributed to Anna Wong of Bloomberg Economics. I can share that quote with you. We expect rising energy prices to keep headlines CPI elevated, even as core inflation slowly moderates. Ultimately, we see annual headline inflation hovering around 3% throughout the year, low enough for the Fed to begin cutting rates, something that Francis was comfortable enough to talk about with us anyway.
And it's basically speaking to this belief that this is a Fed that wants to cut rates. And we got that from Andrew Hollenhorst over at Citi, that even if we get an upside surprise, which is what people are expecting, we could still get a Fed cutting rates, and that they don't think that you should price that out.
Alan Zenner, Morgan Stanley, said something similar, that maybe the bar is lower than you think for the month of June to get that Fed rate cut. Equity futures, session highs up by 0.25% on the S&P 500, going into that CPI print in about 18 minutes' time. Let's give you an update on stories elsewhere. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Delta shares are up in the pre-market trade after a higher forecast and an earnings beat. The CEO, Ed Bastian, expects no let-up in demand in a busy summer travel season. It also helped to lift the shares of United and American Air. Delta is the first major U.S. carrier to give a preview of their current quarter. U.S. mortgage rates topped 7% for the first time in a month. That's according to Mortgage Bankers Association data. Home purchase applications fell by the most since mid-February. Now, despite that drop, the overall index did make a slight gain thanks to refinancing activity. The data cover more than 75% of all retail residential mortgage applications in the U.S. Godiva's parent company is raising prices for chocolate as the price of cocoa soars. Plattis Foods is still finalizing price plans, but it says that it expects global price increases in the high single digits. The company does expect some occasional customer pullback, and total units moved will be declining. Cocoa prices have more than doubled so far this year, surpassing $10,000 a ton. That's your Bloomberg Brief, John.
That's the important news. Danny, thank you. Up next on this program, gold trading near all-time highs.
The other impacts that we're seeing on things like gold, which are completely different, and I think the biggest force there is central banks trying to diversify their sources of reserves.
That conversation up next, live from New York City this morning. Good morning. Your inflation data, 16 minutes away.
Our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West, only on Bloomberg Television. Context changes everything.
Inflation data, 8:30 Eastern Time. Going into it, the scores set up as follows. On the S&P 500, positive by 0.2%. Yields coming in just a touch. We're down 2 basis points on a 10-year, 4.3417. In the FX market, the euro unchanged, unmoved, 108.62 against the US dollar, and crude positive by 0.7%. WTI, 85.81. Under surveillance this morning, gold trading near all-time highs.
The other impacts that we're seeing on things like gold, which are completely different, and I think the biggest force there is central banks trying to diversify their sources of reserves. I think this diversification story will continue. I think we have gone through this. If we look over the last 50, 100 years in terms of the place of gold in central bank reserves, it has gone up and down through time. I don't think it will be a very long-term impact.
Here's the latest this morning. Gold flirting with record highs as investors await US CPI data in just a few minutes' time. HSBC's James Steele saying this: gold keeps rallying even though Fed officials have not made bullish comments and other factors in the financial market are not especially gold-friendly. If the higher CPI number picks up yields, gold could hit some headwinds. Right now, however, momentum buying is overwhelming other facets of the market. James, I'm pleased to say, is with us for the first time in a long time around the table. James, good morning to you.
Good morning.
Good to catch up, buddy. It's great to see you again. Let's just talk about what's happening here and what used to happen. Typically, when you see yields moving this way, you don't see gold moving like this. What is happening? What is the relationship between the two?
No, that's right. We've seen a disconnect. First of all, yields have been positive for quite some time, many, many months now, a couple of years. And the gold market's been able to resist that. There was a disconnect that sort of started at late 2022 and has carried over to one degree or another. Now, we have had a lot of, recently this year, we have had a lot of buying that's come in as a safe haven and hedge against equities. You know, a lot of asset managers, portfolio managers, they have no choice but to be in equities, but they do have a choice about if they want to hedge and how they hedge. And gold's a standout in that regard. It's a very good diversifier and a very good hedge for paper assets. That started a lot of buying coming in, boosted by geopolitical risks, and that's taken us to levels where momentum trading, CTAs, hedge funds have come in more recently in the last couple of months and sent this market to all-time highs. This is despite the fact that the dollar's been pretty firm, and as you point out, yields have been firm.
Can we get to the geopolitics, the physical central bank buying, and what underpins that? What is that story really all about?
Well, there's a couple of things. First of all, you know, you need dollars, and we are running a substantial current account deficit and have done for some time. So many central banks have adequate dollar reserves that they can devote to some buying of gold if they wish to. And central banks are limited as to what they can buy. They only have a few fixed income instruments they can buy and a few other foreign currencies that they can buy. So if they don't particularly want to be, and I'm not saying that they do or they don't, it's up to each reserve manager. But if, say, they wanted to be out of the dollar modestly, reduce holdings slightly, say from 65% to 63%, not to get out of the dollar, but didn't want to go into the euro or the yen, gold is a marvelous sweet spot. You can be out of the dollar without actually being in another currency. The other thing, too, is that, again, like with financial risk, gold has proven to be a good asset to own during periods of elevated geopolitical risk. And gold has actually been going higher since the day after the Hamas attacks. If you look at the market, we declined from late May last year, right to October 6th, as the Fed, as it became clear we were not going into a recession, and the Fed was not going to cut rates, and we came out of the debt fiasco, and the bank stress situation eased. The gold market dropped right up until those attacks, and I'm not blaming it all on that, but if you look at that and geopolitical incidents around the world, it makes it likely that not only would a central bank buy, but others would buy as well.
You're making the sort of central bank buying a lot less dramatic than a lot of people who come on who say they are concerned about the sanctions that the U.S. put on certain places, including Russia and, you know, China. This is a concern for them, and that this is going to continue, and that there's a lot of legs here for central bank buying. Are you pushing back on that and saying this is on the margins, they've filled their coffers with dollars, and they're just sort of rejiggering things, and it's pretty much done?
No, but I'm trying to find some moderate level in between. Central banks are major buyers, and they're buying at least double the rate of the average of the last 15 years. 2022, almost 1 out of every 3 or 2 out of every 5, 1 out of every 3 ounces of gold that was mined ended up in a central bank. So that's enormous. That's almost 1,100 tons. The year before that, it was more like 450 tons. Last year, I think it was 1,037 tons. We're looking for more like 800 tons this year, but that's still well above the levels. So we're just saying maybe not as high in the last couple of years, but higher than we've seen historically. But I think what many of your other commentators are pointing to, and I would agree, once central banks start on a policy course, it's usually multi-year. When they sold gold, by the way, and I remember when they did, my hair was gold at that time, by the way, back in the 90s, they sold for almost 20 years when they did sell, over 15 years. So once they start, and central banks also in the last couple of years published a lot of policy papers on why a central bank would want to own gold, and that was an alert that they were getting interested.
After the freeze on Russian assets, we saw central banks bring back within their control physical gold because they were worried about this. Does that set the direction that potentially we will see more of that in terms of the sanction policies coming out of the United States?
Well, Barry Eichengreen, I believe, and I'm almost sure it was him, that in a paper that he wrote, said that the threat of U.S. sanctions would be an inducement for some central banks to buy gold. And that would obviously
Would you categorize as de-dollarization, though, or is that too harsh?
I think it's slightly too harsh. I mean, at HSBC, we're certainly in the camp that the dollar will remain the world's reserve currency for the foreseeable future for a whole range of reasons. But the point I think to make is that's not to say that they need as many dollars as they have now. So the point being, you know,
interesting.
US dollars 59% of foreign exchange reserves. It's down from in the 60s a number of years ago. You don't have to go into another currency. You could go into gold, and that's what many of them are choosing.
James, this was great. I think you've reminded a lot of Brits at home of the brown bottom in the late 90s. And when he sold all the gold? Bad times. James Steele of HSBC. James, thank you, sir. It's good to see you.
Thank you.
Let's get you an update on inflation, because we need to be talking about that in 6 minutes' time. CPI drops. Mike McKee is in Washington, D.C. to break down that number for you. Mike, what are you looking for?
Well, we're looking for continued disinflation on a short-term basis, with both the monthly headline and core dropping a little bit. But because of energy prices and base effects, the year-over-year number for the CPI headline is expected to rise up to 3.4% from 3.2%. And that would be a disappointment to some. But the core are expected to go down on a year-over-year basis. That might make the Fed happy. See a lot of tweets this morning from people saying this is the most important CPI of our lifetime. Well, maybe not. Of the year, maybe, because it's going to tell us something about what the Fed is thinking as it goes into May and then into June. A rise probably means June may be off the table. A drop, maybe it comes on.
Mike, just real quick here, how high is the threshold to really shift the Fed, given the fact that we have gotten a number of hotter than expected inflation reads over the past few weeks?
Well, I think if the number goes up significantly, then it really does have an impact, and you'll see a big market trade on it. But CPI doesn't usually come in. It can surprise, but when it does, it's by a tenth. And a lot of that now is down to rounding. Everybody's looking at 3 decimal places on the CPI numbers. So it's going to take a lot for something like that to happen.
Mike, sit tight. Stay close. The inflation data, 4 minutes and about 25 seconds away. We'll catch up with Mizuho's Steve Rasciuto, JP Morgan's David Kelly, those two reacting to the numbers as Mike McKee breaks it all down for you. The scores look like this on the S&P 500, positive by 0.1%. Yields come in a little bit lower, down a single basis point. The 10-year, 435. The 2-year, 473. Inflation data up next.
invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Inflation data 20 seconds away. The scores going into it look like this on the S&P 500. Equity futures positive by 0.16%. On the Nasdaq 100 up by 0.13. Switch up the board and get to the bond market. We look a little something like this. Your 2-year down 2 basis points at 473.65. Your 10-year down almost a single basis point, not even, at 435.77. With the data, here's Mike McKee.
All right, we're looking for the CPI data to drop any second now. It seems to be a little bit slower than it has been. Here we go. We're starting to get some numbers in, and we are high, on the high side, 0.4% for both the headline and the core on a month-over-month basis. That pushes the year-over-year number from 3.2% to 3.5% for the headline, and for the core, we go to 3.7 from 3. I'm sorry, we go to 3.8 from 3.8. So no change there. So a disappointing result in terms of the headline numbers. We'll take a quick look and see what we can find in terms of what pushed the numbers up. Food prices were not a problem, up just a tenth. Gasoline up 1.7%, so that's not a major issue. And then we always want to check the used cars and trucks. They fell by 1.1%, so there's something else in here that is pushing it up. It looks like shelter costs unchanged, basically up 0.4%. So I'll take a deeper dive into this and see if we can find out what the problem was.
I don't even need to go through the markets, Mike. You can guess. Another bump in the road, really. Equity futures on the S&P 500, negative 0.9%. We're down across the board. On the Nasdaq, we're down by more than 1 full percentage point. The Russ, sort of small caps, negative by more than 2. Turn the page, get to the bond market. At the front end, yields up by 12 basis points. New highs for the year on a 2-year yield, 4.87. On a 10-year right now, up 10 or 11 basis points to 446.84. With yields higher, you can imagine the dollar stronger. It is against the euro. Switch up the board and look at the euro. Against the dollar at the moment, 108.06 with negative 0.5%. So equities down, yields up, dollar stronger. Mike McKee, are they going to call this another bump in the road? How long before we start calling it new terrain?
Well, you know, you're going to have the people like Raphael Bostic talking that way, maybe Chris Waller as well, because they were already concerned that inflation hadn't started to go down or hadn't continued to go down as they were expecting it to. And now this CPI seems a little bit worrisome because it continues a trend of the past 2 months. There was a thought that maybe January was an outlier, maybe February was an outlier, but now you've got 3 months, and I think people are going to start to say that is definitely a trend.
Which really raises the question, how much are we going to start to move toward the Raphael Bostic view of the world, as well as the Neil Kashkari view of the world of just cutting once this year, and that having sort of the message be, okay, we might go before the election season, but don't expect us to have to move again.
Well, that's going to be a tricky thing for them to pull off because it gives too much of a timing to it. They don't want to bring the election into it. They will say, I don't think anybody's going to change their public view on how many cuts this year or to go to none between now and May 1st, because it's coming up fairly quickly, and we will get 2 more reports before the June meeting. But they might start dialing back this number, and markets are certainly going to start pricing in a 2-cut year rather than a 3-cut year. We get another month of this, they'll probably go down to 1 cut. But to say when would probably put them in dangerous territory. They don't want to, A, give the markets too much of a hint, and B, bring politics into it at all.
Mike McKee, stay close. Let's go through the numbers. 0.4% is the number. The estimate in our survey, the median estimate, 0.3. Strip out food and energy, we come in at 0.4. The median estimate, 0.3. Every time we've seen 0.4, this Federal Reserve has called it a bump in the road. Is it still a bump in the road? For the equity market, it might be more than that. Let's get to the equity board. On the S&P 500, futures backing down. We're negative by 0.9%. On the NASDAQ, down 1 full percentage point. The small caps, a struggle. We're down 2%. In the bond market, Treasuries down, yields up. Now by 14 basis points at the 2-year, approaching 490. We're back to 488. And if you're on 450 watch, we're basically there, Bramo, on a 10-year.
And you can see this being bled out in the bond market in a significant way. You now see only 2 cuts priced into the market in terms of forward expectations. But when you take a look at the currency market, I know you're going to get there. I'm really interested in how much this puts pressure on other countries and other central banks. You see the euro breaking down. You also see the yen crossing that 152 mark. It really puts Japan in a difficult spot.
The dollar's stronger against everything in G10 right now. With us around the table to break this down, Mizuho's Steve Rasciuto, JP Morgan's David Kelly. Steve's been talking about the Fed wanting to cut, but the data's not cooperating. David Kelly, is this data cooperating?
No, the sound that you heard there was the door slamming on a June rate cut. That's gone. I think the problem is the Federal Reserve, and particularly Jay Powell, wants to achieve consensus. He's only had 8 meetings out of 51 meetings in which there's even been a dissent. And so he's going to try and convince the committee, but he can't convince the committee of something the committee doesn't, on average, want to believe. And so he's not going to be able to get consensus around a June rate cut. I don't know if he'd even want to push one at this stage. So unless there's something very weird in these data, I'd love to see what exactly is pushing this, because there's some, there may be things like tobacco prices or something pushing this. I don't know. It sounds pretty high, but it's definitely more inflation than the Fed wants. I still think that they ought to normalize rates over time. I'd be happy enough if they start to cut rates in June, but I think this means that they won't.
The words of Chairman Powell, it's too soon to say whether the recent readings represent more than just a bump. Chairman Powell in the last few weeks. Steve, do they need to change that assessment of this data?
I think they're creating a problem for themselves in terms of the promises of rate cuts, the inability to actually execute on them. Their forward guidance has locked them into something because they want to do something that the data is not allowing them to do. I think they ought to change it. Whether they will or not becomes an interesting question. I think there's enough doves on the committee that will be a difficult thing to sell. I think, as Mike mentioned, they're more likely to hold status quo and just allow the markets to do the effective adjustment for them and wait till they get to the June meeting to make any changes.
I'm struck by the fact that core inflation came in hotter than expected, as well as everything else, at a time when we're seeing oil prices, when we're seeing more broad commodities increase, which creates this question of how much more could inflation rise. I'm wondering, from your perspective, Steve, do you think that this data raises the proposition of a hard landing because it forces the Fed to stay high, even if you see some weakening on the margins?
Well, I think the answer to your question is very simple. I define it as a hot landing, an environment in which the economy slows back towards, 2.3, 2.25 type environment, which is still above the revised CBO trend. I don't know if anybody noticed that, but CBO raised its underlying trend rate of growth in the economy from 1.75% to 2%. So my 2.25, 2.30 number is still above trend. That gives you a tight labor market environment, and it certainly suggests it's going to be very hard to get inflation to the 2% level. So could inflation wind up settling somewhere around 3 as opposed to 2? Yes, so that to me would be a hot landing, not a hard landing. But it still keeps the inflation percolating.
Check out this market move. Let's start with equities. Equity futures, the Russell getting absolutely slammed. We're down by more than 3%. On the S&P 500, down by more than 1%. David Kelly just moments ago, the sound of the door slamming shut on a June rate cut. If you're just joining us right now, 0.4% is the number. The estimate was 0.3. Mike McKee down in Washington, D.C. Mike, you've had a bit of time to chew over these numbers. What is underpinning this one this morning?
Well, the interesting thing is that there isn't any huge jump in any category except motor vehicle insurance, up 2.8%. It doesn't have a huge weight, but it does figure into core services, and that's pushed the numbers up. What you're seeing is a lot of slight increases in a lot of different areas. Rent up 0.5 after 0.4 last month. They were the owner's equivalent rent, the housing component, unchanged at 0.4. So that's still an upward weight on the overall numbers. And we're seeing the same sorts of things throughout this. 0.7 gain for apparel. Things that go over 1%, very little. But a lot of things moved up 0.1 or 0.2 during the month, and that seems to be what's pushing this higher. And that would make the Fed concerned because it suggests a broader base for inflation than just a few outliers like we've seen in the past.
Mike, thank you so much. And I'm looking right now at Supercore, someone noting that it's at 4.8%, not exactly what this Federal Reserve wants to see. David Kelly, I know that you've been really big on the disinflation, the immaculate disinflation, this idea that we were going to get a landing and that it was just sort of this natural base effects that would take hold. Do you question some of that now?
Well, actually, what Mike was just saying makes me feel a little bit better about the situation. That 2.8% in auto insurance, that's probably not a real number. I mean, last month they were saying that auto insurance rates were up 20.6% year over year. Now, I know they're up. I don't believe that negotiated auto insurance rates on a month-to-month basis are actually going up that much at this stage. I also don't believe that a year from now we'll be seeing also 20.6% on auto insurance. We must have gone up some more. And then also, if rents are up, then the owner's equivalent rent is up also. So that it sounds like it's still the same problem of, about over 80% of the year-over-year inflation that we're seeing is coming from auto insurance and the government's measure of shelter costs. And both of those are very smooth, badly measured things which should come down over time. I will admit that inflation is coming. This is too much for the Fed, and they won't want to look into more details to find a reason to cut here. But it doesn't make me worry that inflation, in the long run, inflation is coming down.
Steve, your response?
It's an index. You take the index as what it is. A lot of these components aren't even seasonally adjusted at the micro level and the macro level. They're aggregated, so we can get proper seasonal adjustment behind it. There's lots of components in the CPI. The fact that some components go one way, some components go the other way. That's why we have an index. So I don't really look into the details. I look at the major aggregates and the components, and what they're telling me is inflation's not doing what they wanted on average, and this is a problem for them. They've laid out a scenario, and they actually lowered the bar at the March meeting to cutting rates. And the reality is the economy isn't even meeting that lower bar for them. So this becomes an ongoing quandary for them because they've created a financial market environment that's much too accommodative for what their macro scenario is and what their desire to cut rates are. And therefore, they've created a problem for themselves because their forward guidance is keeping the labor market tighter than it would normally have been if they didn't have this degree of forward guidance. The dots are a bad concept. They shouldn't be there. They lead the market in a direction that they should not go. This has been a mistake since it was created by Janet Yellen. Nobody at the Fed has backed away from it. The reality is I hope when they sit down and review it next year, they realize this is a dumb thing and they walk away from it.
David, do you agree? Do the dots just create this, problems within the financial markets?
No, I don't really have I don't have a problem with their transparency. I do have a problem with overly active monetary policy. I think that we assume, Steve, you were talking about how their monetary policy has kept their forward guidance has kept unemployment tight. I don't think that their forward guidance and rates is having that much of an impact on actual macroeconomic GDP growth. Because if that were the case, the fact that they've raised rates so much over the last 2 years ought to have slowed GDP growth down, and it didn't. So I think the Fed has a big effect on financial markets. You can see that today. I don't think they're having a huge effect on the economy. I do think that some of the ways that the Labour Department, despite the fact that it's an index, the way they measure inflation is adding some bumps to the bumpiness here. These are manufactured bumps. It's kind of like roadworks in New York City. It's not just potholes. It's actually roadworks that's creating these bumps. So I think the Bureau of Labour Statistics themselves are responsible for some of the bumps here. I do, though, think this is a fundamentally disinflationary economy. Inflation is coming down slowly, and I just worry about an overactive monetary policy, which we've had for many years, which basically distorts financial markets for no good economic purpose.
And you talk about running a marathon. You have to fuel yourself before you break down. So if June is slamming the door, you think you slam the door against June, when do you think the Fed should have to step in?
Well, I personally, I think I'd rather them get going slowly and sort of send the message, look, please pay no attention to this. We're not easing, we're just normalizing. I'd like them to sort of message that way. But yes, I do think that they ought to try to get to normal before they need to, because someday we're going to be sitting around this table and the Fed's going to be at a high level, and suddenly the floor has fallen out for some shock or something, and so we're facing the possibility of recession. Then the Fed says, oh, we've got lots of ammunition, we can cut rates fast. But I have never seen that one work out well. If the Fed has to cut rates a lot in an aggressive, responsive way, it always hurts the economy. So I'd rather they just gradually get back to a normal place. But obviously this morning's data doesn't help them do that.
I keep watching the markets right now, and after we got this hotter than expected print across the board, yields continuing to climb, almost really pushing up toward that 5% level, 4.93%, the highs of 2024. I'm also watching the Russell 2000. And Steve, I'd love your idea of this. You say a hot landing. And this raises a question of what this landing is going to look like if you do see some of the smaller companies continuing to be pressured, given the fact that the Fed really just lost their excuse to cut in June. As we heard from David, that was the sound of the door slamming shut on a June rate cut.
Yeah, again, this is the problem the Fed's created. So the reality is smaller companies get squeezed because they don't have the pricing power, but they're getting cost in the wage cost environment, and that's squeezing the profitability. And this is something I think the Fed really thinks they're attempting to do. They're attempting to create an environment where, David I'm in the camp that longer term there are global deflationary stories. The problem is there are a lot of domestic cyclical inflationary stories, and it's a battle between the global deflation versus the domestic cyclical. And this is a battle that's been going on, and the currency's been somewhat of the equilibrated between the two of them. But the reality of the situation is the domestic cyclical dominates more than the global deflationary over time. And the other thing is the Fed keeps on missing the importance of fiscal policy in this equation. It's not only monetary policy that continues to stimulate the economy, it's fiscal policy that continues to stimulate the economy. And therefore, the Federal Reserve's concept of what their neutral rate is, the natural rate that they're looking for, or R-start, I think is incorrect. I think R-start is substantially higher. I think the level of rates that needs to be in environment in order to bring inflation down is substantially higher than the Fed is assuming. And I do believe the market prices the dots. And that's a problem. The market takes a look at the dots and says the dots are this, and this is what we price in as soon as it happens. So the forward structure of rates anticipates the dots, and that's a problem, which is why they should be eliminated.
Let's talk about the price of fiscal policy right now. Can we bring up the bond board? This move at the front end of the yield curve. We're talking about a 20 basis point move on a 2-year yield. We took out 480, we took out 490, we're at 493.49. We're up 14 on a 10-year. There's your round number, 450 on a US 10-year this morning, 450.29. Pass that through to foreign exchange. The dollar's stronger against absolutely everything. Dollar yen took out 152. The euro broke lower to about 107.85. We're negative 0.7% there. And if you are just joining us, we said earlier this morning, it's quiet now, wait until 8:30. This one's loud. Big move. 0.4% is the number. The estimate was 0.3. Mike McKee, I want to come back to you. You've had much more time now. What's standing out to you? How difficult does this make life for Chairman Powell next time we hear from him?
It makes it a little bit of a public difference, but I don't think it's going to make as much of a difference inside the Fed, in part because of what both David and Steve are saying about the idea that this is not driven by a particular thing, but by several broader categories. When you look, and this gets very nerdy, but this is where we are these days, a lot of people looking at the 3-digit numbers for the changes, and we actually see headline go down from 4.0 to 3.78, which rounds up to 4, and we see the slight rise in the core from 3.58 to 3.59. So it doesn't suggest inflation is reversing tremendously because of the rounding, but it does suggest that we have stalled out. And that's going to be the interesting thing for Fed officials to address. It probably means fewer rate cuts because they're not making progress, so it's going to be higher for longer.
Mike McKee, I want to talk about that decimal point. We'll do that with David Kelly. David, let's talk about it. This is an email I got just moments ago. Core CPI month over month was 0.359, which gets rounded up to 0.4.
Yeah.
You know, you come in a little bit lower, you get rounded down to 0.3. Does that make a difference to you? Does that change the conversation in any way, shape, or form?
No, but I think the other thing is, in any inflation rate between 2 and 3%, on the consumption factor, I regard as basically okay. I mean, I think the Fed is a little too focused on getting to precisely 2%, just as I think they were in the last decade trying to raise rates up to 2%. I think trying to manipulate monetary policy, get rates inflation right down to 2%. I think they're a little too forceful in that. So no, I don't worry about it too much. What I look at are two things. One, yes, we've got a lot of demand, but we've got tremendous labor supply. I mean, we've seen increases we're at a 15-year high on the labor force participation rate for the working age population. We've got massive immigration, which is generating labor supply. Year-over-year wage growth at its lowest level since June 2021. So we don't really have a problem there. And then in the longer term, inequality, competition, and the lack of, we've had virtually no strikes so far this year, the lack of any union pressure to push up wages, all that suggests to me this is fundamentally disinflationary economy. I tend to agree with Steve that there are cyclical forces which are making it just a little slower coming down, but I'm fine with the idea that inflation is going to be drifting down and there's going to be a time when we're all sitting around this table wondering what the Fed's going to do to push it up.
You've said a few times that this disinflationary trend, which has hit some bumps in the road over the last few months, had nothing to do with the Federal Reserve. When you just talked about the labour market, you talked about forces that had nothing to do with the Federal Reserve. Why doesn't that play into what Governor Waller is saying, which is basically why do anything at all? What Kashkari is saying is why cut rates this year? Why doesn't that just play into that idea?
Because you're starting in the wrong place. If the Federal Reserve was at a neutral level, I think the neutral level of the federal funds rate is a lot higher than 2.6%, but if they were at, say, 4%, then yeah, they should just focus on their golf game. They do not have as much impact on the economy day to day as they think. They spent a decade trying to speed the economy up, failed. Now they've been trying to slow the economy down, failed. It's clear that they are in a very rough stream with a very tiny paddle, and they are really not moving the boat at all. And so what they can do, though, with a lot of this active monetary policy is disrupt financial markets, misprice assets. Last decade, we mispriced housing terribly, and now a large chunk of younger Americans can never buy a house because home prices are just too high when you've got normal mortgage rates. We've mispriced a lot of speculative assets, meme stocks and mega cap stocks of some kinds, and cryptocurrencies. All were, these things were funded because the carrying cost of crazy was zero. So I wish the Federal Reserve would pay more attention to what they do to financial markets with their manipulation of interest rates and not worry too much about what they're doing to the economy because they're not that effective.
We played the should game. Can we play the will game? What do you think they will do?
I think they'll skip in June. I think they will set that up and then probably at the moment I think they'd probably set up for September and December 2 rate cuts this year.
Yeah, can I just jump in there? Because I think I totally disagree with what David just said a minute ago in terms of what's driving this thing and about monetary policy returning to some natural rate or neutral rate and what that neutral rate should be. The reality is the Fed Reserve was trying to stimulate the economy when there was a debt overhang. The debt overhang was weighing heavily on the economy, and the Federal Reserve was doing what it was supposed to do, offsetting that debt overhang with very, very low subsidy levels of interest rates. COVID cleaned out that debt overhang. Now there is no debt overhang. Balance sheets are exceptionally healthy. The economy has back its animal spirits, and therefore the Federal Reserve needs to be taming back on those animal spirits by keeping the level of short-term interest rates high enough not to allow the economy to get too excessive in its growth rate, to create a substantially higher rate of inflation that then gets embedded in the system. This is the mistake the Federal Reserve made in the 60s that created the 70s, and I think they've learned from that, and hopefully they've learned from that and realized not to succumb to the idea that that there is some natural rate or some neutral rate that we have to get back to, or if monetary policy just gets back to some lower level where we're all fine, the reality is they have to fight against the animal spirits that are created from an economy that has very healthy balance sheets, low corporate debt servicing burdens, low household debt servicing burdens, and a tight labor market that's feeding the engine of the consumer economy.
David?
I think you're talking about Wall Street animals and not Main Street animals. I think
Wall Street is Main Street. I hate to tell you, a lot of it has the same effect. The companies drive their share prices, they keep their employees, all those things matter. What happens in terms of the stock price matters what happens in terms of Main Street.
All right, we just disagree. I don't think that monetary policy is as effective on the economy as you think.
But let's talk about where Wall Street meets Main Street, right? We're going to have a real Wall Street response to this. We already are seeing it right now. And there's going to be a 1-2 punch because we see the price action right now. And then at 1 p.m., we're going to get an auction of 10-year notes that's really going to test the appetite of a market that's looking very skittish. Steve, how vulnerable is this market to a real upset that will actually disrupt some of this easy money conditions and this sort of happy talk that we've been hearing all year?
Well, the reality is these moves tend to be somewhat partially reversed out by the end of the day. I understand the 10-year auction is coming, and it will probably be a sloppy auction as a result of it. But I think the more important point to understand is what this says to the average CEO in this country is inflation is high. Why am I not raising my prices? Okay, I may be getting squeezed on my margins. I've got to get double-digit earnings. I've got a tight labor market. Inflation is up. Other people are raising their prices. Why don't I just raise my prices? You know, and that becomes the self-fulfilling prophecy of creating the inflation environment. And this is where the rubber actually meets the road, because if I'm sitting there in that executive office and I'm looking at my stock getting hit, I want to drive up my stock price. How do I drive up my stock price? Do I go out and suddenly start firing workers? Or do I say, everybody else is raising prices, why don't I?
And this really feeds to this question, David, that a lot of the theses kind of underpinning some of the rally that we've seen in equities.
Well, I hope not, because it would lead to higher inflation if CEOs do that and they say, okay, now's the time to raise prices, or if workers say now's the time to demand a wage increase. The thing is, we wouldn't have come down from 9% to 3% or 3.4%, 3.5% of CPI. That wouldn't have occurred if businesses were actually able to do this and workers were actually able to do that. What we're seeing, if you look at the inflation, when we get the data, and we look at it carefully here, we're still going to be in a situation where 80% of that inflation that we're looking at right now is simply the government's measure of shelter costs and auto insurance. You look at energy, food, goods, everything else, it's not particularly inflationary. And that has to say that we've got a competitive economy in which, yes, everybody wants to raise the prices, they're just scared to.
It's a fantastic conversation, Steve. I'm afraid I've got to wrap it up. Forgive me. Steve Rasciuto of Mizuho, alongside JP Morgan's David Kelly. To the both of you, thank you. If you are just joining us, the number 0.4%, and that 0.1 seems to make a lot of difference from the 0.3 that we were looking for in our survey. 0.4%, the number, and the price action, some major moves in the equity market. Equity futures and equity markets more broadly doing absolutely nothing all week and then breaking lower. Down by 1.26% on the S&P 500. On NASDAQ 100 futures, we're down by 1.4. Things were worse on the Russell, believe it or not. 10 minutes ago, we were down by more than 3%. We're now down by 2.7. The moves in the bond market, phenomenal, higher by almost 20 basis points on a 2-year. We have taken out 490. If you've been missing the last 25 minutes, some big changes to this board. 491.80 becomes 492 on a US 2-year this morning, up 13 basis points on a 10-year, close to 450, breaching that level a little bit earlier. If you transfer that move over to foreign exchange, the dollar is absolutely dominant against G10 right now. The euro breaking down to 107.86. We're negative there by 0.6%. Tomorrow, we'll react to all of this with George Concalves of MUFG, Kenny Kaminsky of Alpha Simplex, Ian Lingen of BMO, and Jason Thomas of Carlisle. Your opening bell, 34 minutes away with a lot to talk about. We'll see if these moves stick. Equities down and down hard.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal. The Deal. That deal. The Deal.
Huge deal.
Who dug this up? What are y'all's in trouble?
Wow.
From New York City, for our viewers worldwide, I'm Menace Cranny in for Jonathan Farrow. So the equity markets grappled with a spike in yields at 2s and 10s. Short end of the curve shreds the rate cut probability here in the United States to less than 50 basis points for 2024. The impact on stocks? We spend the next hour counting it down to the market open.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Coming up on the show, U.S. inflation comes in hot for a third consecutive month. That sends stocks sharply lower and yields spiking higher across the curve. Traders slash the rate outlook for 2024. We begin with that issue. Another surprise to the upside for CPI.
The sound that you heard there was the door slamming on a June rate cut. That's gone. I think the problem is the Federal Reserve, and particularly Jay Powell, wants to achieve consensus. He's not going to be able to get consensus around a June rate cut. I don't know if he'd even want to push one at this stage. It's definitely more inflation than the Fed wants.
Let's get straight to the numbers. Mike McKee is with us in Washington, D.C. So, Mike, this pervasive, sticky inflation, it's broad.
It is. And the Fed is not going to be happy with this. They've been looking for more confidence that inflation would keep going down. Instead, it has stalled out. We see on a rounded basis, if you look at the 3-digit numbers, they were in the 3s, but they round up to 0.4 for both the headline and the core on the month. And that pushes up the year-over-year numbers as well. Not something that you wanted to see if you're the Fed and you're maybe talking about rate cuts sometime soon. That does seem to be off the table. If you take a look at what it was that put us here, it's, according to our ECAN breakdown, it is the services. Services continue to be the biggest thing that are affecting the overall inflation rate. A little bit of energy price rises. We saw some medical care services, and we saw motor vehicle insurance rise. All of those, except for the energy, fall under the services category, and that's why we are still having such a big problem. Now, if you want to see what that means overall, we take a look at the numbers that show housing there. Housing is still at the same level it was, up 0.4 for owner's equivalent rent. It went up to a 0.5% rise for rent of shelter. So housing is still a major contributor, and we're not seeing the progress that we thought we would see. And so it is a major issue for the Fed overall, and it isn't clear what they can do about that, because the Fed stopped moving back in July of 2023, but inflation hasn't moved down really since.
Well, certainly not what they want over at the Fed. Mike, thank you very much. Great breakdown there, Mike McKee in Washington. Let's continue the conversation. My guests this morning are Robert Tipp of PGIM and Matt Egan over at Loomis Sales. Gentlemen, good morning. This is, to quote Mr. Kelly, just a few moments ago from JP Morgan Asset Management, this is the sound of a door slamming shut on a June rate cut. So the consensus is going to build, isn't it, gents, towards less cuts and later. Is the door firmly shut now on a June cut? Robert, good morning.
Yeah, I mean, I think that the Fed really doesn't have anything to do here. They have, taken the Fed funds rate up to a level where growth has remained very firm. Inflation has come down a lot, from 6% on core, 9% headline. We're down under 4% at this point on a year-over-year rate. But as we saw with the jobs number, you can argue about what are the causes of the growth that we're having in the U.S., but generally speaking, growth is firm, financial conditions are easy, and the Fed doesn't really have anything to do. So I think the patience message started to come out a little bit more clearly. They've been up and down on this over the last year, sometimes sounding a little bit impatient, like they wanted to start cutting rates to avoid a passive tightening of conditions. But I think there's pretty good reason for them to remain on hold here, see how things go. I will, remind everybody, of course, prior to the most recent few months, we had 6 months of really good inflation prints that were down in the target zone. So this could be a fluke, but it's a strong economy. Energy prices are up. It could be a while waiting for them to begin cutting rates, and then not much coming in terms of rate cuts once they get started, for all we know.
Well, it is 3 misses in a row. I love the line on the MLive blog this morning. To underestimate 1 or 2 inflation prints may be misfortune, but to miss several in a row looks careless. Matt, good morning. This is not what the Fed want to see, and it emboldens the Waller-Bostic narrative. Later and less, and perhaps a lot less than this market thinks. I mean, the short end and the long end are both virulent this morning, up 18 basis points on the short end, and indeed pressing higher on the long end as we speak. Good morning.
Morning. Yeah, to answer your prior question, I do think it shuts the door on a June rate cut. And the question, I guess, now, are there going to be any rate cuts the rest of this year? Our overarching view has been that because of some of the mega trends that your show has been talking about and others, that there are pressures for that pushed us into an unstable inflationary regime. That means that you get more variability to the upside through the cycle, but inflation itself is cyclical. We were of the view that inflation was on the downside. That was clearly evident, and then the question was, where is it going to bottom out? And for how long before it starts to hook back up again? And 3 data points in a row, maybe that doesn't make it a trend, but you keep looking around. It's like whack-a-mole. Something comes down. One of the factors comes down. One of the categories comes down on the inflation data, and another one pops up. So this trend, it does seem like the danger here is we're bottoming out at this level, and then in some places even hooking up again. So that's the danger, and you can see the effect it's having on the market. Interesting with people are wondering what was going to cause the risk trade to kind of falter, and well, here you have it.
You used the language there that it's about stability or instability, but this is just darn sticky inflation, and it's going to delay the capitulation of money market funds out of money market into risk assets, isn't it, Matt?
That's right. We've all been watching the massive amount of money that's built up into the money market accounts. Not all of that was going to get redeployed into the markets, but there was this sort of wait for a Fed rate cut to finally happen to kind of push that out the curve, pushing it back into the fixed income markets. And perhaps you're going to need to wait a little bit longer for that flow to materialize.
Now, of course, Robert, this to you. You talk about traversing. I love the language that you use, traversing these new higher levels, and that is a strategic buy zone. So I'm just working on the assumption there must be a mountain of real money buyers ready to come in here. 494 on 2-year paper. You want to buy the short end. You had a nice spike in duration. These kind of virulent moments in markets, what opportunities do they present for duration hunters?
Yeah, absolutely. I mean, I think what we're seeing play out, and hinted at this in the paper we put out last year, High Plains Drifter, and highlighted these money fund balances in the quarterly that we just put out, the second quarter outlook. Money fund balances at 21% of GDP is really elevated relative to normal levels, and these are starting points for very firm markets. So that money, is it going to come out quickly? No. But we have been seeing steady flows into the long-term markets, and those are likely to continue. So is this a rough day for the market? It is, but yields are high. And I think that's why this yield curve is inverted, because investors are keeping long rates below short rates because they want to make absolutely sure that they lock in these returns for the long run, because eventually you're going to have lower short rates. So I think we're going to have to adjust to this slower course. It's not going to take that much in terms of market movement, but then you're going to go back to earning these high yields, which I don't think is a bad thing. And it's going to be a different bull market, not where the rates drop down immediately and you got a big pop in return and it's over, but one where we stay up in this high range. Your high yield, your emerging markets, your investment grade corporate, structured product, they earn these high yields for a very long period of time to come.
I like what you had to say in regards to, I mean, it has not been the year of the bond yet. Let's just keep that very squarely in our mind. But, it has been a pretty good party in high yield, Robert. It has been a very good party in investment grade. I just wonder, I mean, I know we're having a dislocatory day, and we probably will run into this bandwidth now. We'll trade 4.5, maybe we'll touch 5. But we're in a new band zone of trading in sovereigns. What does that do for the rest of the year for the party in high yield and for the investment grade, the tightening in spread there, Robert?
Right. Well, that was the case last year as well. There was no, money made in the market until you got to the end of the year. Yields dropped, and it was a good year for bonds. In the first quarter of this year, long-term yields went up a bit, but high yield performed, EM performed, the higher risk markets posted positive returns. So this is a great backdrop in the sense that you're not looking at economic contraction. You're not looking at an economy that looks like it's cresting rapidly and with a lot of downside risk. It's looking like one that has solid growth that the Fed wants to take the edge off of. And that's a really good environment for credit. Managements have been terrified by the pandemic, by SVB, by the higher interest rates, that there's going to be a recession, Mm-hmm. As a bond investor, that is what you want. You want managements to be cautious and working for the bondholder to maintain their credit quality, their access to markets. You don't want them to be overconfident in the investment backdrop, in the economic backdrop, and levering up. So spreads are tighter. They have come in a lot. There's not a lot of room for wholesale tightening from here. But I think that these incremental spreads are likely to produce income and some further tightening, over the long term here. It's going to be a good backdrop for credit product, I believe.
Matt, on days like this, lots of people who do not have the right exposure either to equity or indeed to bonds and to yield, they're going to welcome this spike in yields and the drop in equity. This print in CPI, what does it do to overall risk and risk management? What kind of conversations will people be having today?
Well, I think it does represent an opportunity. I think we've been advocating moving out the Treasury curve. I'd curb your enthusiasm on the very longer end. I think, structural deficits in the United States and the amount of T-bill, the amount of bonds that have to come to the market and clear could be problematic for the longer end. But I do think the intermediate part of the curve represents decent value here to kind of push out your duration into that area. I think there's less risk, certainly, of a Fed rate hike, so you can collect those higher yields. And if we do indeed go through a normal cycle and we start some sort of, cutting exercise by the Fed, you'll absorb that. I think there's less scope for the long end to come down, though, in this rate cycle, because I think it's going to be really, really shallow on the downside. And we have to keep in mind, the long end is sort of like a bullwhip, right? So if yields move like they move today, or with future concern about structural deficits in the United States, that's going to crack, and that crack on the long end is going to be, bond yields moving higher. So I'd be cautious on the long end, but that intermediate part is attractive. You were mentioning spreads in the market. I felt this year we had moved too far, too tight in spreads in the corporate market. People were chasing, and they were looking at just the absolute yield, but spreads, which is what you need to get paid for, have contracted a lot. And I think we're not expecting a lot of losses to develop. We agree with the notion that losses are going to remain low and fundamentals are pretty good. But you do want to get sufficient risk premium to compensate in case you are wrong on that event.
Indeed. And there's perhaps just not enough in the spreads there. You can be a coupon clipper, but perhaps not enough in the spreads to compensate. Right. Gentlemen, thank you so much for your first reaction. Shelter gasoline prices driving over half of this CPI bump to plus 0.4% on the headline and on the core. If you're just tuning in at 14 minutes past 9 this Wednesday morning. My guests, Robert Tipp, Matt Egan there. The implications for the equity market, we have not had a 2% drawdown in these equity markets for quite a long time. Nasdaq down 1.5%, S&P futures down 1.4%. So again, pre-market, we're looking under the hood to get some of those movers, a flavor of what's driving the growth to value narrative or the dissipation of that. Let's ask Abigail Doolittle.
Yeah, and those losses on the S&P 500, if they hold on the day, Manus, will be the worst day since the end of January. This, of course, as fears that liquidity will not be coming back into the market as yields back up. The two-year yield nearly at 5%. Not surprisingly, big tech really getting hit hard. Valuation fears really at play here. Amazon.com down 1.9%. This stock up more than 80% over the last year. So too far, too fast narrative coming into play. Fears around that the good times may last. Tesla, on the other hand, not up over the last year, down 2%. Fears that the liquidity crunch would maybe hit their business and create even more difficulties for the path ahead in terms of growth. One stock that is climbing higher, Delta Airlines up 2.5%. They, of course, put up a good quarter, and the outlook for the year, it is better than expected on a revival of business travel, Manus.
There you go. Come fly the friendly skies. I don't think that was their tagline. Abigail, thank you very much. Quick snapshot of what's going on in the bond markets. This is what matters to risk. This is a hot CPI report, and we are now shredding the possibility of 3 rate cuts. We're down to 2, and they may well be later and less. November from September. The bond market is not waiting for an additional print to take the losses. Right here on Bloomberg, 4.5% on 10s.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The deal?
The Deal. The Deal.
That deal. The deal.
Huge deal.
Who dug this up? One of y'all's in trouble.
Wow.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions. Season is coming.
I think we're all asking the same question.
Just how much earnings growth they're expecting.
Bloomberg is first to break the numbers.
Gilead is coming out right now.
We have Take-Two numbers.
Shares of Pinterest.
Lucid Group coming out with its earnings.
All eyes right now on NVIDIA.
A lot still to come.
With the smartest insights.
How much bigger could profit and revenue have been?
Better than what the street was expecting.
Bang in line with estimates.
We will have full and instant analysis.
It all starts Friday on Bloomberg. Context changes everything.
It is the third consecutive month of hotter-than-expected inflation data, underscoring the challenges facing the Federal Reserve and providing a new headache for President Biden ahead of this year's looming election. Let's extend the conversation now with our very own Enda Kern, who joins me from Washington, D.C. I like what the blog team have written, which is this. They're channeling their inner Ms. Havisham, Charles Dickens, 1861. To underestimate one or two inflation prints may be misfortune, but to miss several in a row looks like carelessness. I mean, the Fed, they certainly look as if their guidance is now perhaps misguided. This is not just a bump in the road. 2 months of hotter CPI. We're now up to 3 in a row. Enda, good day.
Good morning, man. It's not just a bump in the road. Yes, the usual suspects of gas and shelter are there. They made up about a half of the increase overall. But when you look into the details, prices are going up for furniture. They're going up for fixing your car. They're going up for buying clothes. They're going up for going to see the doctor. It's a fairly broad-based increase in inflation across the board. And it kind of pushes the narrative beyond this idea that maybe there are 1 or 2 kind of shocks at the beginning of the year that people are willing to look through and attribute to idiosyncratic factors. The conversation before I come over here now, the reaction from analysts seems to be that there's a risk that inflation is actually accelerating again. And of course, that has big implications both for the Federal Reserve and potentially on the political side of things as well.
Okay, and certainly there was a virulent reaction in that bond market right the way across the curve. You've got 2s and 10s spiking higher. Obviously, 10s doing most of the work as there is perhaps a little bit more concern about enduring inflation. Up 13 basis points on 10s and 2s. Up now 20 basis points. 21 basis points. We're down to 50 basis points for 2024. Rate cuts will be later and less than the market had anticipated. That's your bond market in a pretty virulent mood at the moment. The belly of the curve up 18 basis points. From the bond market to Boeing, more trouble. A former employee accusing the company of taking shortcuts during the production of the 787 Dreamliner aircraft this time, saying this: in a mad rush to reduce the backlog of planes and to get them to market, Boeing did not follow its own engineering requirements. The company pushing back, saying that the claims are, quote, inaccurate. Benny Camel joins me now for more. Benny, it's not to say this company was recovering from 737 MAX. There's a cap on what they can produce. But I want to know exactly what this whistleblower is claiming now that I'm about to step on a Dreamliner, or the next time I step on a Dreamliner. What should I be worried about?
Well, that's exactly the problem, isn't it? That now in the public narrative, there is a sense that these planes are no longer safe, and this is a huge issue for Boeing. You know, for decades, this company was the standard bearer of flying safe and producing great planes, and that narrative has really slipped since January 5th, where we had that blowout on the 737. And now, you just quoted him last night, this whistleblower came out, a Boeing engineer who's worked on the 787 program, and it's worth reminding people these are very different aircraft. The 737 is a plane that stems from the 60s, essentially, the original design. The 787 is a sophisticated carbon fiber plane that was hatched at, at the start of the millennium. It's the most advanced aircraft, and it also means it's more complicated to put together, and that's where the allegations come in. This whistleblower is saying that the way that Boeing was putting these aircraft together, they were fitting these single sections together, was done in a clumsy, in a sort of too rushed kind of way. They should have been slower. They should have pointed out the gaps that might exist in these barrel sections and so on. And that's something it didn't do. They put speed over precision. They put profit over the process, and that really goes to the heart of the problem that's facing the company right now. Is this still a reliable manufacturer? And that's a huge lot of work for the next CEO coming in.
Indeed, and the questions now arise as to whether Calhoun can really make it through to the end of the year, as was suggested. Some serious issues which the company have denied. It must be expressly said that the company has responded. Benny Connell there with the very latest on Boeing. Coming up, your morning calls, and that's joined afterwards by Megan Horneman from Verdence Capital Advisors with me on this hotter than expected CPI print. If you want to look at it in these terms, that core CPI up 0.4%, takes the 3-month annualized to 4.6%. This is Bloomberg.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera, and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
Nobody brings you top names like Bloomberg.
The expectation that interest rates are going down is creating animal spirits again.
Bloomberg. Context changes everything.
Time for your morning calls. Let's take a look at what the analysts are saying on Wall Street. First up, Truist downgrades Deckers to hold, saying recent data points to slower sales growth. Next up, Morgan Stanley cuts Boeing's price target down to a street low, $180, expecting slower deliveries, longer oversight from the FAA. And finally, Argus downgrades Yum Brands to hold, warning of slower customer traffic, weakening menu prices. Coming up, we're going to talk to Verdence Capital Advisors on the market implications of yet another hot CPI.
names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. Your fixed income fix. Watch Bloomberg Real Yield at its new time Friday at 12 p.m. Eastern right here on Bloomberg. Context changes everything.
At some point, there was going to be a pinch point. Today is that day. Spike in yields challenges the growth to value narrative, and it literally wipes out. Look at this. Russell futures down 2.5%. These are markets that are grappling with later rate cuts and less rate cuts. Now less than 50 basis points priced into this market for 2024. They may be clapping there. This could be a temporary reprieve. Don't forget, if you haven't got your allocation into stocks, maybe this drawdown is your opportunity. That is what you're going to see in your inbox as we go through the rest of the day. Now, it is critically important. The dollar is flying higher across all G10. But look at dollar yen. We talked about this red line in the sand for the Japanese, for the Bank of Japan and the Ministry of Finance at 152. We have busted through that. So it's going to be a fascinating 24 hours in terms of what BOJ does to that. Two-year yields up 18 basis points. This is a shredding of rate cuts expectations for 2024. This emboldens the Bostic and Waller narrative, and oil is up by 0.4% as we have this, I suppose, residual concern about what happens on the geopolitical front, as well as a strong economy. One stock to watch at the opening, it is Delta Airlines, posting better than estimated results, delivering upbeat outlook for the travel industry. Abigail Doolittle is with me. Abby, I've only been in coach so far on Delta. Take me through. What's it like at the front?
Well, coach is not so bad on Delta, Manus, for sure. And investors right now liking the results from Delta, given the fact that the stock is up 3%, the best day in about 3 weeks, at one point closer to a month. And this, of course, on results that were better than expected. But it's really the outlook that folks like and the commentary about the future. CEO Ed Bastian saying that there is no let up in demand going into summer. Of course, summer being that all-important travel season. Business travel is very strong. So as a result, we do have the stock, or excuse me, the adjusted profit, the range, $2.20 to $2.50 per share. That is above the 223 average. This is for the current year, going in again into the important summer travel season. And one analyst at Citi saying that the results and the guide look very encouraging. And when you put this together with some of the recent travel scares that we have, investors encourage that stock again up 2.5% on the day, Manus.
Okay, Abby, thank you very much. We're also watching the Boeing stock under pressure. Again, a whistleblower claiming that the company took manufacturing shortcuts, this time on the 787 Dreamliner aircraft. Grady Greifeld is with me. I mean, this was quite a quite a piece of theater yesterday with a whistleblower, with lawyers, and a press conference.
Absolutely, and the takeaway here is that there's still a long way to go when it comes to Boeing's recovery, made longer by what you were saying. Of course, that whistleblower alleging that the company took those manufacturing shortcuts on the 787. Remember, most of the scrutiny has been on the 737 MAX model. That, of course, was the aircraft involved in January's Alaska Air incident, but now that scrutiny extending to the 787 manufacturing process as well. And it's interesting, of course, these allegations came on the same day that Boeing reported first quarter deliveries, and we learned that Boeing delivered 83 aircraft in the quarter. That is the lowest tally since mid-2021. And of course, they delivered about 29 planes specifically in March. Now, you compare that to what we heard from Airbus. Boeing's rival delivered 142 aircraft in the first quarter, 63 handovers last month. So Boeing clearly falling behind here, and you can really see that in the shares. You take a look at Airbus, it's currently higher by about 18% year to date. You compare that to Boeing, it's down a little bit today, but down a whopping 32% so far in 2024, Manus.
Katie, thank you very much. Stock down by 0.25%. Turn our attention to tech. Alphabet impressing the street after unveiling a host of updates. You got it, around AI and the offerings during its annual cloud conference. Ed Ludlow is with me. Did they impress?
They impress, although the stock's down 0.8%. I'd say that in this post-CPI market for technology stocks, that's relatively buoyant as things go, and it's worth noting the stock was higher in pre-market by 0.5%. The sell side are really positive about what Google did. So much of the conversation we've had about AI or generative AI as a tool has been in the context of chatbots that are consumer-facing, but the real battleground is the enterprise customer using generative AI through cloud platforms, a market in which Google Cloud Platform is a firm third place behind Amazon AWS and Microsoft's Azure. The real thing that the street is seizing on is their Google Cloud Platform's developers application, which is called Vertex AI. And in a demo that Google gave Bloomberg, they basically demonstrated how if you're a marketing firm, you can upload images, marketing-related images, to Google Drive. The generative AI or Gemini 1.5 Pro model then takes those images and you can basically ask it to do whatever you want. Make me a slideshow or a presentation based on those images. They also showed off cybersecurity use cases and other app development. And it's the first tangible sign that Google feels that the model that they have out in the marketplace, Gemini Pro 1.5, is ready for real time. It's ready to be used in the enterprise use case. And across all of the sell-side notes, there are many. If there's one commonality, it's that this will see Google accelerate its cloud growth and potentially continue to chip away at market share at the number 1 and 2 placed AWS and Microsoft Azure. But yeah, the stock down 0.5%, as I say, in this post-CPI tech market, that's buoyant. I think I'm right in saying that there's just one single or a couple of stocks in the green on the NASDAQ 100 anyway.
Yeah, I mean, it's down a third relative to the index. It's down a third on a relative basis to that. Thank you very much, Ed Ludlow in San Francisco. Let's turn our attention to China. Jack Ma applauds Alibaba's latest overhaul plan in a rare memo. That's after stepping away from the spotlight. Isabel Lee is with me. It's rare to hear from Jack Ma. What did he have to say?
Rare indeed, Manus, and he re-emerged from seclusion to boost the morale of his company, which is quite sagging. Jack Ma wrote in a lengthy post in Alibaba's internal forum that he's praising the efforts of the 2 new leaders of Alibaba, which is Eddie Wu and Joseph Tsai, and saying the company is on track. So to your point, this is rare because this is only the second time in the past few years that he has re-emerged from his seclusion, and the first time was 4 months ago, and it was a reversal because in that re-emergence, he was actually criticizing Alibaba and even praised a rival. He said, right now, though, it's the right time for the company. He reiterated calls to think outside the box and to escape from what he said is a, quote, big company trap. And recall that last year, Alibaba had this huge plans to restructure its sprawling empire into 6 little Babas or baby Babas, but that still has yet to pan out. Ma still looked up to by around 200,000 of his employees, so this is welcome news. Shares are up now at around 3%. In Hong Kong, it closed higher by 5% to the most in 2 months. So shares of Chinese stocks in Hong Kong has been really quite lackluster in the past month, but recently it's been showing signs of revival at the robust manufacturing data, and we have JP Morgan saying investors should consider using cheap options as a way to seize gains. Manus.
Isabel, thank you very much, baby Alibabas. And a hot CPI report. That is what we are dealing with here in March. Prices rise more than expected. And my next guest writes this. While investors want rate cuts, a strong labor market and Fed funds rate that is not too restrictive suggests the Fed may be on hold until the second half of 2024. That might get later and later. Let's see whether Megan Horniman is moving forward with later and less rate cuts post a hot CPI from Verdant's Capital Advisors. Megan, good morning. Later and less cuts?
Yeah, absolutely, especially after the print today. I think a lot of people were talking about the first couple of months and those surprising numbers as having some seasonal factors and maybe one-off situations, but we're seeing that now 3 months in a row with hotter than inflation numbers. And then some of the things, whether it's commodities, whether it's looking at the ISM manufacturing report, that those prices paid jumped up. These are just showing that inflation is becoming a very stubborn situation for the Fed.
Well, it's also going to become a hot political potato. Housing and gasoline costs contribute to more than half the increase in the overall CPI. Discomfort, one could say, in Capitol Hill as well?
Yeah, and the problem is that the Federal Reserve really can't do anything to control either one of those. That's going to have to come from some sort of fiscal policy or government change there. But the Federal Reserve can't control gasoline prices, and they can't build houses, so they can't make home prices go down.
I think it brings into question the potential of an SPR release. I mean, we're looking at gasoline prices literally on a straight line higher. Let's reset for a moment. We've got a hot CPI, core CPI also rising. The 3-month is skirting towards 5%. So we have hot inflation, and yet you are one of the first guests to really lean into the LEI, leading economic indicators, suggesting that there's some cracks in the economy. So I want you to paint a picture for me on what that is. Wages, we know, are not ratcheting out of control. There's a broad-based spread in inflation. So where are the cracks?
So when you look at that leading indicator index, this has been something that's been around for decades and decades, and it's typically always been a precursor to a recession. And what we've seen is we just finally got 1 month where I think it rose about 1/10 for the month, but it's been consistently negative for a very long period of time, the longest it's ever been that hasn't led to a recession. So the cracks that we're seeing is that I think let's take a step back first of all and look at why we're getting a resurgence in economic growth here in the first quarter. A lot of it has to do with, unfortunately, the Federal Reserve giving some very conflicting messages. They came in the fourth quarter of last year, and even though the unemployment rate was very low, inflation was not anywhere near where they wanted it to be, they got dovish. And they even told us that there would be rate cuts this year without getting inflation to where they needed to be. This caused an increase in consumer confidence, and this caused an increase in some of the economic activity. But underneath of the surface, consumers are extraordinarily strained. I think they're spending with the anticipation the Fed will cut rates, but we have credit card debt that's extraordinarily high. We have delinquencies that are rising, not just in homes, but also in auto loans and credit cards. This is showing that the consumer is not as strong as these data points are showing. That's a concern. We haven't addressed commercial real estate. We haven't addressed the commodity market and how we're seeing that put even more strain on households. These are all things I think are just going to keep a lot of pressure on the economy as we get into the second half of this year.
Translate that into action for me in the portfolio, because if the headwinds are as stacking as you're suggesting, and we're not paying enough attention to them, do I lighten up on consumer cyclicals? Do I build up in defenses? I've got gold running up higher. That can come for any number of reasons, whether it's central bank buying or perhaps more retail buying. But the concerns you've just laid out, most other people want to go pro-risk. It sounds like you want to go pro-defense.
And we have been, we didn't participate in that whole AI-driven momentum rally where we saw the valuations on the S&P 500 skyrocket to levels that we did not find justifiable, given the fact that we think the Fed rate cuts were way too optimistic for this year when we came in to 2024. So from a portfolio positioning, there's a couple things to do. First of all, make sure that you're in balance with your asset allocation. Some of these tech stocks, some of this growth has run up so far and so fast that your portfolio portfolios may be overweight to those areas when you don't want it to be. Take some profits there. There's nothing wrong with having a combination of both defensive stocks as well as cash. The Fed is not, in our opinion, is not going to be making any moves anytime soon. There's no reason why you can't sit in 5% cash, wait for the market to pull back like we've starting to see this cracks in the markets recently, then look for the opportunities. Look at where those long-term opportunities are. We will get through this. We'll likely have a slowdown, if not recession. And when we come out of that, some of those areas that are beaten down, that haven't participated in this rally, small, mid-cap stocks, these are some of the areas that tend to rally the most when you come out of an economic downturn. And that's where we'll look to add some money.
Well, if I look at the estimates for earnings, I mean, a lot of people have said the valuations are high. Don't worry, the earnings will catch up. Calm down. Stop being such a burr. Never met a wealthy burr. But if I look at the Citigroup earnings estimates, I mean, we're seeing upgrades outpace downgrades. So I'm duty-bound then to say to you, are the upgrades just too optimistic, or how do you see the earnings season at the start of 2024 panning out? We're going into the banks this Friday.
So the earnings expectation for this quarter, for first quarter 2024, it's one of the slower quarters, but still positive earnings. Where we are concerned is that for the full year, there was expectations for 10 to 15% earnings growth. And this is a year where there's a good chance the Fed's not going to be able to do much, and the economy is going to slow down. So how does that translate into earnings? A lot of people are holding on to hope for this AI-driven earnings boom. Well, we haven't really seen what AI is bringing to the earnings table yet from the broad market perspective. I think that there's going to be some concern in these earnings seasons that people are going to want to get paid for it, or pay these extra. They're going to want some justification on why they pay these elevated multiples for these stocks.
Okay. Megan, let's see how the reporting season kicks off on Friday with the major banks. That is Megan Horniman, my guest this morning from Verdant's Capital Advisors. Coming up in the show, we are quite literally on the edge. We've got inflation topping out on the estimates for a third consecutive month on the core. Now, this is the curve, 2s, 10s, flattening as you can see. There has been a virulent repricing, pushing out rate cuts to November from September, and we briefly topped 4.5% on the 10-year government bonds. So there's been a major repricing on this. There you go. There's the pricing right now. Coming back from the highs very initially after the CPI print, up 11 basis points on the 10s now. Politics at play. President Biden responding to the data just moments ago. The details next from the White House on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Just looking at your portfolio of businesses, it is about resilience, it's about pressure, it's about women. Like, so how does that come together how does it manifest in the deals that you're doing now?
Yeah, it's one of the things that I became increasingly passionate about after I retired, was acknowledging the fact that focus and this performance mindset was a huge asset that I had gained and that I had worked on and perfected for over 20 years. And now working through brands and founders, I just recently announced a collaboration with the Aman Hotel Group, where I bring in the best talents in sports recovery and performance mindset in retreats and offering it there to their clientele. Our first one is actually in Phuket in February. So working through what that means, I mean, if you see the stats of Fortune 500 female CEOs, 80% of those women have played sport competitively through their life journey. And all those skill sets that they've built, to me, they were part of this first chapter, right? But how do they now apply to everything else I'm doing? And I'm so curious and interested in how I can bring that to the audience now and make it more mainstream and accessible.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
What this says to the average CEO in this country is inflation is hot. Why am I not raising my prices? Okay, I may be getting squeezed on my margins. I've got to get double-digit earnings. I've got a tight labor market. Inflation is up. Other people are raising their prices. Why don't I just raise my prices? You know, and that becomes the self-fulfilling prophecy of creating the inflation environment. And this is where the rubber actually meets the road.
Joining us now to continue that conversation on the latest CPI print, it is Bloomberg's Mike McKee. Mike, in the very first aftermath, we saw this very virulent bond reaction spiking higher. We're just coming off the highs of the day. As you dissect the data, is there any clarity around the driver of this spike?
Well, the problem is there's a sort of broad-based increase in a lot of different categories, not very much for most. The biggest increases came in motor vehicle insurance, up 2.6%. It's up 22% on the year, and it's been rising for quite some time. The insurers say it's because it costs more to fix today's more expensive computerized cars. But that's something that monetary policy isn't going to be able to affect. We also saw a rise in energy prices, which the Fed can't affect. So maybe there's a relationship with that in the markets. You can see in the graph right there that we have seen prices continue to rise, but on a year-over-year basis, what we're seeing is a stall in the monthly change and the year-over-year change in the CPI. So prices are going up. We're not making progress on bringing the rate of inflation down, and the Fed is going to look at that and say, well, higher for longer.
They absolutely are, and that is reflected in perhaps the breadth trade today, the Russell 2000 under so much more pressure. Mike, thank you very much. And indeed, the core also rising on a 3-month basis, closer to 5%. Let's talk about those sectors. Who's taking the bruising this morning? Abby's with me as ever, side by side.
Yeah, it's a pretty brutal day today, Manus, because we do have the S&P 500 down at this point 1.2%, off the lows of 1.5%. At that point, heading to the worst day since January, but not surprisingly, all 11 S&P 500 sectors are lower. The worst, real estate down 3.6%. Now, this should not be surprising given the fact that yields are higher, so those dividends look less attractive. But in addition, the farther the higher rates stay, the more pressure that puts on the overall real estate sector. Utilities also down 2.2%, high dividends there as well under pressure. And you can see that most sectors are sharply lower. Consumer staples even down 1%, healthcare down 1%, industrials, financials, consumer discretionary. So lots of pain on the day. We haven't seen this in a while. Confirmation of this hotter inflation data. Let's take another look at the real estate sector, because if we put it into the perspective of a chart, we're going to just see how painful this is. Down 1.5% over the last 3 days. And of course, Manus, earlier this week, we did have the news Blackstone buying Air Communities for $10 billion. Lots of thinking there that that could open up the space, a space that's largely expected to come under some pressure or even a crash because of rising rates. But now with this inflation print, it's probably going to create a little bit of fear and uncertainty around what's next for commercial real estate, offices in particular.
Yep, and of course we had that conversation with HSBC just a few weeks ago here in the studio, and saying perhaps the worst course, is behind us on CRE. Abby, thank you. We've got a mirror image of what Abby has just talked you through in the Russell 2000. This is where the real pain trade is. If these rate cuts are later and less and emboldening the Waller and the Bostic narrative, then it is going to be those much more inflationary sensitive sectors, as Abby had been saying. So this is reflective on the real estate and utilities, which she pointed out there. Real estate down 3.74%. The only thing in the green so far in this year on the Russell 2000, it's got to be said, is the energy component, which has outperformed on a global basis. Let's dig a little bit deeper. The President of the United States has reacted to the latest inflation data, writing this: I have a plan to lower costs for housing by building and renovating more than 2 million homes. And I'm calling on corporations, including grocery retailers, to use record profits to reduce prices. Will they? Enda Curran is with me. He is in Washington. And I mean, these policies which Joe Biden is espousing, he's not going to be able to build enough homes to materially change the housing component, the owner's equivalent rent, by November. And I've seen retailers over the last 35 years rarely respond to missives in size from political capitals.
Yeah, and time is running short from a policy viewpoint if you really want to turn around some of those big structural issues between now and the election. I mean, Manus, the other issue is that, you know, shelter and gas made up half of the increases in inflation for sure, so the housing shortage is a big part of this. But it's also more broad-based than that, and that's probably the most worrying point for the politicians involved in this process. It's the cost of furniture, it's the cost of clothing, in particular for women and children. It's the cost of going to see your doctor. It's the cost of education. That's not even to mention the cost of insuring your car or getting your car repaired. I mean, this is kind of pretty much across the board. Economists are now worried that inflation is starting to accelerate again, or it was meant to be the year of disinflation. And on groceries, by the way, the president talks about groceries. Actually, the food price component is pretty good. Prices for baked goods have fallen by the most they have since they began keeping records on that side of the CPI basket.
And thank you very much. Yeah, certainly uncontrollable issues for the president trying to impact from afar. Coming up, market moving events to set your diary by on Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
You want to focus on the auction today for 10-year government bonds, $39 billion. What will the appetite be? Plus Fed speak from Goolsbee and Barkin, post that CPI. Then we roll on to Thursday, the PPI and the jobless claims. Jobless claims are going to be critically important, and we have an ECB decision. Of course, Friday takes you to JP Morgan, Wells Fargo, and Citi on the results trail for Q1. Countdown to the open. That was it. The team will take you through the rest of the
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal?
The Deal?
The Deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
Wow.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City. To our worldwide audience, you're listening to Bloomberg Intelligence. Alex Steele and Paul Sweeney with you. We tend to focus on here in the next couple hours companies, their security, stocks, and bonds. And we lean heavily on the research analysts at Bloomberg Intelligence, over 400 professionals covering 2,000 companies, 130 industries globally, and we lean into those folks at Bloomberg Intelligence throughout the next 2 hours. Boy, today inflation data hotter than expected. We're seeing that in the markets. The S&P's off 1%. Got yields higher. The 2-year Treasury's up 21 basis points. Big moves in the market. So we're going to break that down. Francis Donald, global chief economist and strategist for Manulife, Investment Management. She's going to join us in just a couple of minutes, and we're going to kick it all off. But first, let's go to John Tucker and get a Bloomberg Business Flash, John.
All right, Paul and Alex, this report being brought to you by Interactive Brokers. Discover the future of trading with their next-generation trading platform, IBKR Desktop. Download IBKR Desktop at ibkr.com/desktop. Treasury yields, they are surging as stocks selling off after the hot inflation report, a so-called core consumer price index that strips out food and energy, increasing 0.4% from February. And the Fed swaps pricing in now only 50 basis points of easing this year. That equates to roughly 2 rate cuts. As for the yields, let's start with that 2-year. I can't remember the last time I said a 21 basis point pop for the 2-year. That's just under 5.
It was a few months ago. I think it was around maybe last year.
That's why I can't remember.
It has happened. Fair enough.
I can't remember what I had for dinner last night. So that brings us under 5, just under 5, 4.95 for the policy reactive 2-year. The 10, that's up 13 basis points. That right now, just about 4.5%, 4.49. And David Kelly at JP Morgan Asset Management reacting to this morning's inflation print.
It's definitely more inflation than the Fed wants. I still think that they ought to normalize rates over time. I'd be happy enough if they started to cut rates in June, but I think this means that they won't.
And equities selling off as well. The S&P 500 down 1%, 54 points lower, 51.55 in the index. The Dow down 478 points, and the NASDAQ 100 down 190 points. That's a 1% sell-off. After its positive earnings report, Delta Airlines among the leaders in the S&P 500. That's up 2.6%. And one of the standouts today, shares of Funko, FNKO, the ticker symbol, they're up 2.6%. They make bobbleheads. They were initiated a buy recommendation at B. Riley Securities, which said the launch of the Pop Yourself line, which lets consumers create their own customized Funko Pop vinyl figures, is a potential game changer that could boost customer reach. So you can imagine, folks, you can now get an Alex Steele bobblehead, a Paul Sweeney customized bobblehead,
which I expect on my birthday. So it's in about 2 weeks, and you can deliver that for me.
2 weeks. Okay.
Yeah.
I don't know what the lead time is for a Funko bobblehead customized Alex Steele
figure
doll.
it out in the next segment. That's awesome. He was teasing Funko, and I purposely didn't look it up to see what was happening. And I should point out, John Tucker, that we last saw this level on the 2-year November of last year. But a lot has happened since then.
Like I say, I don't know what I had for dinner last night. So when I say I can't remember the last time it was popped up 21, I wasn't lying.
Which is all fair. Also, we had a breach of the 5% level also around the same time. So anyway, just watch that space for sure, particularly the 10-year, as it breaks some key levels. Well, that happened.
Yes, it did.
It's
nice
made
for
to
a
have
busy
news.
morning. Yes, we did. I mean, I think we saw immediately in the bond market, just kind of see some, and we saw in the futures market, I'm looking at the warp function now, through year end, less than 2 rate cuts are priced in right now. Remember, it wasn't too long ago when we were pricing in 6 rate cuts.
I know.
So inflation, I guess they call it sticky. I guess that's a technical term.
Yeah,
so,
sticky.
I don't know.
Sticky, confusing. It's also interesting, the market reaction function, right? If you have a solid jobs number, that's good news equals good news. If you have the hot inflation, that's whatever news that is bad news then for equities. Abigail Doodle is joining us. She is digging through all the market reactions. What's standing out to you right now?
Bonds for sure. That 2-year yield, as you were mentioning, I guess the highest level since November. What I'm looking at there is it's the biggest backup since the SVB blow up last year. So that's the degree. There were 3 days last year around that blow up where it went higher by 22 basis points or more. Right now, that 2-year yield above 21 basis points. A few days ago, it technically confirmed for a move above 5%. So Jamie Dimon's call yesterday for 8%, not so crazy at this point. And we, of course, over the last few weeks have talked a few times about one of the key themes that I'm watching, thinking about is 2024 the year of the cuts. Now, if you listen to Fed Chair Jay Powell over the last couple of meetings, you would think that it is. If you watch bond markets, markets into today, you would wonder whether or not it is. And you guys were just talking about the idea that not so long ago, 6 cuts were priced in. Now it's 2. Are we going to then go to 1 or 0? The one thing the Fed doesn't want to do. And what's so interesting about Powell's pivot this time is the fact that they were so careful about not wanting to repeat the 1970s, and then all of a sudden it's just like the faucets are open, and now based on the data, because of course they have that conditional logic in there, maybe the faucets are going to close, and that does have stocks down, but down about 1%, so not as stand out as yields, screaming higher.
Yeah, I just was being back and forth with Vince Signorella, who's market strategist for Bloomberg News, and he was just saying, hey, just talking to traders, if this thing can hold a down 1.2%, maybe on the S&P today, maybe it could, that might be the bottom. They could trade up a little bit there, just from a technical perspective, intraday trading, and that seems to be what's happening, at least at this point. And, Abigail, it seems interesting. Like, again, we had the Fed pivot late last year, and then the commentary, when we hear from the Fed president, seemingly every day now at various conferences, and particularly Fed Chairman Powell saying, we're still committed to rate cuts, yet you get data like this, and that kind of puts him in a little bit of a box, I would think.
It does and it doesn't, because he does use that data dependent. And even the last, when he spoke, I think at Stanford last Friday or 2 Fridays ago, and I mean, the messaging was wild, because on the one hand, he was saying, well, we don't know enough yet, we might cut. And then on the other hand, it's a soft landing. So right now it gives him the room to go back into the hawkish camp. I just want to take on what Vince Signorella was saying, because yes, if the S&P 500 stays above last week's low, maybe we bounce higher. On the other hand, it's awfully close to the 50-day moving average. The NASDAQ 100 has already crossed below that, which suggests that there could be some actual acceleration to the downside. And in turn, that may suggest that we're going to see a whole repricing of risk, because we've seen it in bonds for a while. Now, bonds doing a lot more today than stocks, but we've already had a roughly 50, 60 basis point more backup on yields into this print. Stocks, though, just basically at all-time highs, but on less breadth, because that RSI has been coming down. So investors who have been buying recently in these record highs, a lot less enthusiastic than they were last year. So I don't think that this is entirely surprising. We just have confirmation that, again, of that sticky inflation you guys were talking about.
All right, Abigail, thanks a lot. Really appreciate Abigail Doolittle joining us there. I'm interested to see we are breaching those technical levels for the markets, but then what winds up happening to buying the dip? Does that materialize, or do we actually get a proper longer sell-off? Frances Donald is a global chief economist and strategist for Manulife Investment Management, and she joins us now. Great person to talk to on this. Do you think investors buy the dip on this?
Oh, I'm not sure I'm there just yet, Alex. I mean, we've been living in soft landing euphoria where everything is perfect. Growth is coming in just fine, but inflation is declining. And we've said you can't have your cake and eat it too. Either growth will hold in too long, inflation will reaccelerate, and you will lose your rate cuts, which is what's happening. Or, and I think this is the next phase of this, growth will deteriorate and you will no longer be in this soft landing narrative. So we still have concerns that even though inflation is coming in sticky, growth is going to decline in the second half of the year. So what worries me is this word stagflationary is probably going to come back a lot more in our narrative in the next 3 to 6 months. That's a very difficult place for the Federal Reserve to be. They're going to have to pick their favorite child, Sophie's choice. Is it inflation or is it growth? And I think it's a really difficult environment for risk assets. They're going to have to deal with the worst of both worlds.
Oof, that's no bueno. So how about the Federal Reserve? If I'm Fed Chairman Jay Powell, in the back of my mind, do I have a scenario where I don't cut rates at all this year?
Of course, that's always a scenario. I mean, the team and I sat down this morning. Our base case has been the Fed would go later but faster, but we'd penciled in June as a starting point. And so I said, team, are we moving to September? And all of us agreed, we got to wait in the next 24 hours. There is so much Fed speak coming forward. And I think as well as I do, it's not uncommon to see extra Fed speak pop up when you have big moves of this magnitude. So what we want to know is not the data itself, but what is going to be the interpretation of the data. There were many categories in today's CPI that are not going to flow through as strong to PCE. Right. Does Chair Powell want to emphasize that? What about that wages are decelerating fairly rapidly and all of our leading indicators of wages say, well, there's not going to be a wage price spiral. If the Fed wants to cut in June, they have enough data to be able to say, hey, hey, we're going to cut in June. If they like to take the opening the bond market gave them to go later, then you'll probably hear a lot less from them in the next 24 hours. They'll try to stay mute. But this is this part in the cycle where macro forecasting and Fed forecasting becomes a little less science and a little more art. It's a lot more subjective. I need to hear what Powell says, not just what the data looks like.
And just talking about sort of market reaction, euro dollar is down as much as 1%. We're now at 1.07, biggest drop since July. So we'll just watch out for more of those superlatives as we go. You mentioned the PCE CPI thingamabob, and I say thingamabob because like not everything counts in the same weight with different baskets. But you had the firmer motor vehicle insurance cost and medical care, and both of those are what feeds into PCE differently. So why, how, what does the Fed talk about with that?
Whatever they want. And this is what's been really challenging for us is there are measured like 6-month annualized CPI ex shelter heading into this was sub 2%. That was totally enough for the Fed to be cutting, or they can lean on the shelter side of the picture. So this is a really challenging environment where the Fed can choose what numbers it wants to focus on. They can tailor which data they reference to what they think is the appropriate outcome. We're talking a lot about inflation here, but let's not forget the job side of the picture. The job side of the picture, when you look at the leading indicators, is weakening. And there on then, they can say headline job growth is good, or they can say full-time jobs have been deteriorating very sharply, and that suggests there's going to be labor market weakness. That's why listening to the Fed is going to become paramount. And unfortunately, especially for those of us that are trying to actively trade it, a lot more volatility in rates in the next couple months.
All right, well, if the underlying jobs data maybe is not as strong as the headline data, and we have persistent inflation here, that's got to be tough on the consumer out there. How do you think about the U.S. consumer?
Depends which consumer you are. I know there's a lot of depends coming through here, and it's because we have so much diversification and desynchronization. This is a really big term. I mean, this week we had a horrible small business optimism number. It was more like small business deep pessimism number that's very consistent with dark recession. And yet CEO confidence is off the charts. Look at consumer confidence by income. High income consumers are feeling gosh darn good, and low income consumers are struggling. They're out of excess savings. Their credit cards are too expensive. They're going delinquent. If you're a high income consumer, you're a saver, you're benefiting from investment returns and house prices returns, you're in really good shape. Let's not forget those high income consumers, the top 20%, they spend 35% of all expenditures. So if you're a consumer right now that is interest rate sensitive, you are feeling recessionary. If you are not interest rate sensitive, then things look really pretty for you. The key here is not to cherry pick which side of this you're going to look at. It's to understand from a policy perspective that the economic experience across income groups and regions in the US is very different.
Yeah.
And from an aggregate perspective, to look top down and say, what does this look like in totality, not just looking at one side of the picture or the other.
So, and to that point, sort of just looking at the areas where we saw increases versus decreases, I found to be so interesting. Not to like bore you guys, but things like car insurance and clothing and personal care and education and furniture, that all went up, right? But what went down are things like the price of butter, for example. Grocery store foods went down. Cereals and bakery products, so like gourmet croissants. So like it's hard. So I wonder, are we in like a rolling inflation scenario where we kind of saw that last year and the year before when it comes to rolling recession in certain areas of the equity market and the and industries? Are we in that place right now?
Possibly. I mean, on the flip side, goods are actually in straight up deflation right now. So where we're seeing the inflationary pressure is on the services side. But we were a little bit worried today when we were going through the number. We said, look, apparel is starting to pick up. There's enough categories that the momentum is moving in the wrong way. So that's causing a little bit of concern for us. One thing I can't help but think about is last year, my team and I were saying constantly, hey, when the Fed cuts rates, you won't be asking why. And yet in December, when Chair Powell pivoted, I constantly was asking myself, why? What changed from October to December to really create this movement? It didn't seem like a good idea. And there's going to be criticism on Chair Powell, I think today especially, that he pivoted too early. He eased indirectly and therefore inflated the economy a little bit too early. I think that's going to be some of the pressure he gets. Now, on the flip side, if they say, okay, you know what, we're going to push out rate cut expectations to later this year, you might see some of that inflation come back. It is a veritable roller coaster. For our clients, we tell them, focus on the 2-year horizon. 2 years from now, rates will be much lower than where they are now. Whether they start in June, September, or frankly, 2025 is less relevant for most investors than that 2-year cycle. So that's what we're advocating, focusing on not big bets right now, not super tactical bets right now, unless, of course, you have to.
I like that 2-year view. Makes sense to me. That being said, we do have the warp function on the Bloomberg terminal where people are kind of pricing it out month to month here. So are you guys in the camp that says, hey, this Fed doesn't have to rush, they can wait as long as they want?
Well, we're very bearish on the economy compared to consensus. We still have a recession in our forecast. And actually, today's inflation print, which tells us the Fed is going to stay a little bit longer, amplifies our concerns about recession risk for later this year and into 2025. So we see 2025 as being really underpriced when it comes to easing. But for the rest of this year, as I said, we're going to listen to the Fed a little bit in the next 24 hours. It's going to be June or September. Of course, we're going to have a lot of short-term focus on that. But big market moves should really be driven off of, are we heading into a recession? Is it a traditional easing cycle with hundreds of basis points of cuts? That's going to be far more important for asset allocation decisions for bonds and stocks than June or September.
Frances Donald, thanks a lot. Manulife Senior Chief Economist and Strategist over there. Yeah, and that's so interesting too, because when you take a look at what the forecast is, does it matter why they cut? Like, are they cutting because the economy stinks, or are they cutting because they're normalizing? And if they're normalizing, that's not going to be like 300 basis points of cuts unless the economy super tanks.
Right.
So does that change how you allocate?
Yeah, exactly right. And I think what a lot of folks took from today's data is, in any scenario, you could make a stronger case today that they can wait a little bit.
Yeah. Or why aren't we talking about hikes?
Why aren't we talking about hikes? Right. Yeah. That's no fun, though.
No, it's no fun, and we don't like doing it. But like, why aren't we actually talking about it at that point?
Yeah, exactly. But again, looking at the 2-year Treasury, up 21 basis points, 4.95%. John Tucker can't remember the last time he talked about 21.
Right before Thanksgiving.
Right before Thanksgiving.
I can't remember.
This
yesterday
is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom, with this Bloomberg Business Flash. Inflation running hot again for the month of March. Core prices topping forecast for the third month, rising 0.4%. So this suggests the Fed will bide its time on cutting rates. Now, as far as market reaction, the real standout, the 2-year Treasury yield, we've been telling you about that, 20 basis points higher, right under 4.95 for the policy reactive 2-year. 10 of the 11 major industry groups are lower in the S&P 500 as far as stocks go. Real estate, the biggest drag. Energy, the lone sector in the green. Shares of Constellation Energy, they're there. That's up 2.3%. The leader, in fact, in the S&P 500. They're going ex-dividend. They moved the dividend to May 10th from May 23rd. So the ex-date falls before the May 17th options expiration. At the end of the day, all about how much money a company is making. Earnings season kicks off Friday. Ahead of that, Wall Street strategists boosting their year-end forecast for the S&P 500. Deutsche Bank strategists say earnings are expected to post a healthy 10% gain. S&P 500, 44 points lower. That's down about 0.9%. So we're pairing some of the earlier losses. 51.65 in the index. The Dow down 378 points. The Nasdaq 100, 172 points lower. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Pull it, Alex.
Thank you so much, John Tucker. I should point out the S&P is off the lows of the session, just down 0.8%. I feel like my buying the dip question isn't as crazy as maybe we would have thought 2 hours ago. So let's ask it now to Shanna Sizzle, President and CEO of Benaron Capital Management. She joins us now on Zoom from Chicago, Illinois. Shanna, do you buy the dip?
I always buy the dip.
Oh, okay. But
I mean, the market goes up more than it goes down. Why wouldn't you buy the dip? It's not like the market's going to go permanently down. I'm a big fan of buying on weakness, and there's weakness today for good reason. Also, I feel the need to tell you, I heard your earlier comments about Funko, and I had to have my bobblehead in the shot for that reason.
Oh, so is that a Funko bobblehead?
It is. It is.
Is that your head?
I had to do it. That is supposed to be my head.
All right, we're going on.
I don't know how accurate it looks, but that's supposed to be my head. But I digress. No, I'm a big fan of buying on weakness. We have strong economic growth. CPI coming in hotter than expected is an indication of that. We still have very strong demand. I think the market's weak, obviously, on the fact that this makes a Fed rate cut less likely. But I've been saying all along that I thought the 6 that was originally priced in earlier this year was a pipe dream. Thought it would be more like 3. Now I'm actually going to go really far out on a limb here and say I don't think they're cutting this year.
Torsten Slok over at Apollo Management agrees with you. He was out with a note this morning reaffirming that call for him. Shannon, so when you think about your portfolio, think about the stocks that you like out there, how much do you worry about Federal Reserve policy, about the interest rate environment vis-a-vis the fundamentals of those companies?
I think it affects some of the growthier names more than it affects, say, a name like FANG, which is on my list. That's an energy name. I think that's more a supply-demand situation. I think the demand for oil in particular isn't going anywhere anytime soon. But for the growthier names, Fed policy can really impact the valuations and the potential upside because of just how time value of money works. Higher rates tend not to be helpful for growth names because you got to have more growth. And so, you can't get as much of a premium as when rates are really lower. But I don't worry about it too much because I think the overall tailwinds are so compelling that even in a higher rate environment, higher rates mean the economy is doing well, which will mean that stocks should do well.
And FANG is Diamondback Energy. Just to break that down, that stock trades about $205.85. So you mentioned that maybe the Fed won't cut at all. Does that pare back the amount of cuts you expect overall in this cutting cycle? Because that would also dictate kind of how the economy is doing.
Yeah, so I think that the Fed has a target interest rate. So I think they'll cut as much as they have to get to what that target is. I think it's probably somewhere between 2 to 3.5. It's not zero. I know we got used to zero, but it ain't zero. And so I think we'll get there. If they have to do it faster and there's less cuts, that means that we've had some sort of economic instability. That's how I look at it. If there's more cuts, that means that we've achieved the unicorn soft landing, which I'm still not convinced of. So I don't have an opinion on that. I just think that more cuts means smoother landing, right? That stupid thing when you fly, smooth landing, Air Force pilot. Yeah. So we've achieved a smooth landing. The Air Force is in control. And if they have to cut fast and they're bigger cuts, it's because there's some sort of economic stability and they have to hit the deck really hard.
All right. So a name like NVIDIA, which is a name we've talked about with you before, you guys own that. I can't think of a interest rate scenario that would get me off of that story, because I mean the fundamental drivers of AI, if you really believe the growth potential of AI, that is got to be a building block story in that. So how does the movement in today's market kind of impact your thoughts about a big growth story like NVIDIA?
Well, you and me both. I don't think the Fed has any impact on NVIDIA because of the AI trend. We're so early on there. It's trading at like a 28 times forward earning multiple, which is insane to me. I still look at like just the sheer price of it at over $850 per share. And that's intimidating because my cost basis on it is $250. But not to brag or anything. I don't own that much. I don't own that much and I haven't added to it. That just sounded really obnoxious. But yeah, so I'm not sure I'm necessarily a buyer, but I do find the 28 times forward earnings compelling. So maybe I jump in here, especially on weakness like today. If it got under, say, 825, I would be jumping in all day long.
You also own Vertex Pharmaceuticals, ticker VRTX. It's a biotech company. Tell us more.
So that's a super volatile company. Biotech is not for the faint of heart. But I like some of these healthcare names right here. Some of the more volatile ones, actually, because drug development is always volatile. You might think you have something great, and then you get to, the stage 3 trials, and all of a sudden everything falls apart. Vertex has some great cystic fibrosis drugs. The stock has been super volatile, but volatile to the upside. So you get some really crazy movement in the stock, but the stock has positive returns. I think they have kind of a dominant position in cystic fibrosis, which is a major concern. That's a major disease that affects a lot of people, and those things are positive for the stock. They have some great R&D, and those are the things that I think are the key drivers. It's good management, smart balance sheet, all the things you look for in a good stock. But it is biotech, so it is not for the faint of heart.
Biotech, not for the faint of heart. NVIDIA, one could argue, not for the faint of heart. How do you guys screen for stocks at your shop? I mean, do you tend to go for growth? How do you screen?
So oddly enough, my entire background in all the years I've been in the business has been value. So I know that seems strange looking at like my recommendations here. But I don't screen the way that you would normally hear. I started my career in manager research, and so I used to meet with managers of funds, hedge funds, mutual funds, ETFs all the time, and they talk about their stocks, right? So I got a lot of my ideas from them. So I've met with thousands of managers at this point in my career, and there are like a handful that I think are amazing. And those handful are the ones that I will look at their portfolios. I'll look at their 13Fs and see what they own, maybe pick up the phone and ask them, and find out their reasoning. And then I'll do my own work on the stock, see, does it make sense to me? Is this story something that I think is compelling? But that's how I get my ideas. I don't screen for stocks like most folks who sit there and pick, 20, 30, 40 stocks because they have to manage a portfolio. At any given time, I might be following 10 names because that's not the core of our business, but that's kind of how I get my ideas.
Gotcha. All right, Shanna, thank you so much for joining us. Really appreciate that. Shanna Sissel, President and CEO of Banrian Capital Management. Crude oil inventories rose 5 1.84 million barrels, EIA says. Do I care about that kind of stuff?
You care. Let me just see what crude is doing.
I mean, crude is
right
kind of
now.
unched on the day.
It was a little bit higher, so it's been a little bit mixed. But yeah, it definitely turned lower on that news. Yes, you care because we're also looking at any disruptions that might have happened from the Baltimore Key Scott
Will
Bridge.
you tell me how they measure those? Do they send like an intern out with a big dipstick in the tank?
Wow, that's a great question. I have no idea.
Because
Or maybe they just pick up like Cushing. But there's like a bunch of pads. They're called pads, and that's where all the storage kind of sits. Maybe they just call each pad or something. The pads are all over the country.
Okay, we got pads, and we have to have pads in Elizabeth, right?
Well, I don't think that's crude oil though in New Jersey off the turnpike.
Like,
Some
right.
are. I think we'll have to.
For
we'll have to get
example,
back to you on that.
Pad 3 is near the Gulf Coast, so that whole section is Pad 3, and then there's like Pad 1, which I feel like is the East Coast, but I have to get back to you on that.
Okay.
Anyway, yes, you care.
Okay.
We have enough oil. It's the products that are going to be dicey.
All right, very
How's
good.
that for you?
WTI crude oil pretty much off about 0.2% here, $85. But it's all about inflation today. The CPI coming in hotter than expected, reigniting some concerns that this Federal Reserve may not be cutting rates in 2024, certainly a lot less than we came into the year thinking. We're seeing that reflected in stocks and bonds here today. All right, we're going to have more coming up. Right now, though, let's head to New York City with our news. Michael Barr.
Thank you very much, Paul, Alex, John. Alan Weisselberg, the longtime chief financial officer of Donald Trump's real estate company, was sentenced to 5 months in jail for lying under oath during New York's civil fraud case against the former president, setting up his second stint behind bars. Weisselberg, who is 76, was sentenced this morning in New York State Court. The ex-Trump CFO pleaded guilty in March. His plea deal does not require him to cooperate or testify at Trump's criminal hush money trial, which begins Monday. The Arizona Supreme Court has delivered a landmark decision in giving the go-ahead to enforcing a long dormant law that bans nearly all abortions. Frustrated Democratic Arizona State Senator Eva Birch told reporters she had an abortion a few weeks ago for a baby she wanted very much.
Somebody gave me a procedure so that I wouldn't have to experience another miscarriage, the pain, the mess, the discomfort. And now we're talking about whether or not we should put that doctor in jail.
The law is set to take place in 2 weeks. President Biden says Israel's prime minister is making a mistake and needs to allow a 6 to 8 week ceasefire with Gaza. In a wide-ranging interview with Univision that came after the airstrike that killed 7 World Central Kitchen workers, Brown University political scientist Wendy Schiller says public opinion is shifting over Israel's handling of the war.
Biden is sort of a little bit behind, certainly his own wing of his own party. But now with the American public saying, wait a minute, the way you're conducting the war is not, acceptable to us, and we have concerns about it, then he's trying to stay ahead of more general public opinion now.
Brown University's Wendy Schiller was a guest on Bloomberg Daybreak. Switzerland will host a high-level conference in June to consolidate global support for a peace formula advocated by Ukraine. I'm Michael Barr, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Treasury yields, let's start there, soaring, reaching new year-to-date highs. The Fed swaps pricing in 50 basis points of easing this year, which equates to only 2 rate cuts at this point. This all comes after the hotter-than-expected CPI. 2-year yield is right now, well, 19 basis points higher. Stocks are lower, but they are moving off the session lows. The S&P 500 right now, 35 points lower. That's down 0.7%, 51.75 in the index. The Dow Jones Industrial Average, 317 points lower. That's down 0.8%. NASDAQ 100, 138 points lower. That is down 0.75%. Steve Rasciuto at Mizuho Securities says the Fed at this point is in kind of a tough spot.
Their forward guidance has locked them into something because they want to do something that the data is not allowing them to do. I think they ought to change it. Whether they will or not becomes an interesting question.
And Delta Airlines shares, they are higher right now, up 1.4%. The carrier forecasting adjusted earnings per share for the second quarter that exceeded the consensus estimate at midpoint. Boeing shares, they're down 1.4%. Their problems keep mounting. The latest is there's a whistleblower, an engineer. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Paul and Alex.
All right, thank you so much, John Tucker. So lots of drama unfolding after that hot CPI. Paul's been bringing it up. The WIRP function, WIRP, that's where you go to see what everyone's sort of thinking about, Wall Street and investors alike, about what the Fed's going to do. And it's currently pricing in about 2 cuts. Man, that is a very different kind of scenario than we saw just a few months ago. Well, let's break it down. Sally Bakewell is Bloomberg U.S. Finance Team Leader, and she joins us now. Sally, as we dig through here, how many reports are in your inbox about pushing a Fed cut back from June to?
Yes, approximately 2,000 of them are in my inbox.
Excellent.
And I think the level of uncertainty remains, but I guess there is this sort of clear expectation of a path to cutting, and around that, Wall Street banks, which will start reporting on Friday, are probably going to have to be rethinking some of the guidance they've given on one of their key sources of revenue, which is net interest income. They had, just a few months ago, warned that they would probably see a slide in this metric, but it's looking like they'll be able to up some of the guidance on this now.
Yeah, it's interesting. I'm looking at the reporters in this story on your team here, put in some, showed some of the big banks were providing 2024 guidance, and pretty conservative looking. And I guess it reflected kind of what they were thinking at the time, which is the market's pricing in 6 rate cuts. We have to reflect that in our P&L. Do you think we'll see revised guidance here? Is that some of the issues in the market?
I mean, I think that's what analysts expect. I think investors are also optimistic of that. And the big question seems to be JP Morgan. It is being looked at as one that did have particularly conservative guidance at about 90 billion of net interest income for 2024. And it may have to up that based on the fact that, that was... They brought that out when they're expecting as many as 6 rate cuts, and now if there are only 2, they'll probably have to revise it. And Wells Fargo is another one being discussed in the same vein. But I think analysts are saying a lot of the big banks, which are sort of more asset sensitive than the regional lenders, could have to rethink their guidance.
But that only holds in a good way if the loan demand is also good, right? I mean, that's the whole idea. Will loan demand be good?
Well, I think as we see banks reporting earnings on Friday, we are expecting to see quite a subdued loan demand because the sort of lagging effect of higher rates is still ongoing. But yes, if interest rates come down, that is in theory a sort of big tailwind for lending because people start to borrow more. I think it should, in theory, be a sort of positive thing, but there remain uncertainties here that might sort of cloud the kind of expectations that loan demand could come roaring back.
Yeah, I mean, just on Monday, just looking in this article here from Bloomberg, on Monday, JP Morgan Chief Executive Officer Jamie Dimon delivered a warning on the economy. So, he might say to his CFO and investor relations person, say, well, wait. I don't think we need to be taken up our guidance here a little bit because he may have some underlying concerns about the economy.
Exactly. And actually, people are saying that potentially JP Morgan anyway waits till its investor day if it wants to boost its guidance and does it then, and that's in late May. But definitely, Jamie Dimon, he kind of gave his couched assessment of the economy, which is that consumers remain healthy and they are spending, but there are all kinds of inflationary pressures. There's this very difficult geopolitical backdrop, the transition to sort of a greener economy, ongoing fiscal spending, all these inflationary pressures that actually are a big overhang to sort of, a really robust economy continuing. And that could definitely end up dampening sort of the consumer's ability to borrow.
And that investor day for JP Morgan is May 20th.
All right. Mark your calendars.
Snag an invite. Maybe we should go.
Yeah. Good idea. Yeah. Take radio down there. Okay. Here's my pet peeve. Marcus, so we all familiar with Marcus? Okay, it's Goldman Sachs' high yield savings account, right? They lowered their rate 10 basis points on Friday. That's not okay. The Fed hasn't done anything. What's going on? And that's my personal way of talking about the deposit beta when it comes to these big banks and then what the Fed's doing.
Right. I mean, I think they continue to be under pressure to stop customers going to other high-yielding options. And I suspect that's, what Marcus is doing.
No, they cut it.
Oh, I see.
They cut it 10 basis points.
Okay.
You're not getting paid as much.
Now to be fair,
you're not getting paid as much.
You're right. It's like 4.6%. They took it to like 4.5 or something like that.
But you put it on an account of your size. That's real money.
I mean, we're looking like billions at this point.
Yes.
But still, but the idea that they're already kind of front-running cuts that may not happen till September.
Wow. I mean, that's fascinating.
So what are the banks? I mean, as we were talking about before, one of the things is just simply, are they making loans out there? Are they suffering charge-offs? What do we think that we're going to hear from the banks as it relates to the credit quality and charge-offs of their loans, things like that? Because I know that's a big metric.
Well, I think charge-offs are expected to be pretty stable, actually. And again, I think that's another sort of signifier, an indication of consumers being in relatively decent health. But of course, they were reliant to a degree on a lot of the savings they amassed during the pandemic, and those, of course, have faded and will continue to fade. So again, the situation with charge-offs seems pretty stable at the moment, but there are those headwinds. And I think also a lot of banks are expected to set aside more money in provisions this quarter than they have done in the previous quarter a year ago, which is another indication that they see sort of storm clouds on the horizon and that people will start to default on their loans and loans will sour and they'll need to be able to cover the cost of those.
We've seen M&A start to pick up, investment banking start to pick up. Is that going to be squashed a bit if we still have higher for longer?
I think this is really interesting. It seems like a lot of the investment community and companies have gotten somewhat used to the current interest rate situation and the current uncertainty, which sounds a little bit paradoxical to say. And for that reason, they have been more willing to do some deals. We've seen a pickup in deals. We've seen IPOs sort of start to slightly rebound. So I think higher for longer hasn't been there's been a persistent deal slump for months and months and months, but investors have started to get used to this sort of uncertain rate path, I think. And so they have been coming out of the woodwork a little bit.
Interesting. Right, could you see the certainty? Ralph, you're the former investor. You're the recovering investment banker. Yeah. Is it the rate or is it just the certainty or the trajectory?
I think it's just the trajectory here. So, I think, I think the market's more normalized. We're seeing investment grade market be very robust because, they can get deals done. And so they're going to get them done. Could they have gotten them done at a lower rate 2 years ago? Yeah, but that's 2 years ago. Here we are. We need to fund growth. Mm-hmm. So again, just a trajectory of where things are going. So anyway, Sally, thank you so much. We appreciate it. Sally Bakewell, U.S. Finance team leader for Bloomberg News, with the article out today from her team. Wall Street banks may redo key profit guidance on fewer rate cuts, i.e., take net interest income forecast a little bit higher.
Yeah, that'd be really interesting to be, and just even if they don't do it for their earnings season, like recalibrating it, just the commentary on the calls will be quite interesting, and I'm sure that analysts will be all over them to answer that question. So that'll be very interesting indeed. And also for the JP Morgan, the Citi, and the Bank of America, the consumer part of it, and how their charge-offs are doing, and what their read is on the consumer. As Francis Donald was talking about, just two totally different worlds, two totally different consumers.
Yep, absolutely. So we will see J.P. Morgan reporting on Friday, so that'll be...
You're off, though.
I'm off. You're darn right I'm off.
He's not going to care till Monday. All right. This is Bloomberg.
Your company news headlines on Bloomberg Radio.
And I'm John Tucker in the newsroom with some of the company news we're following. Inflation. This is the part of inflation that really hurts. The price of a box of Godiva chocolates rising due to surging cocoa costs. Godiva's parent, London-based Platis Foods, still finalizing pricing plans, but they expect percentage increases globally to average in the high single digits. An assorted box of 18 pieces of Godiva chocolates weighing 7.75 ounces currently retails for $36. Well, cocoa prices have more than doubled just this year, surpassing $10,000 a ton. And do I have to remind you that how cocoa is pollinated, the cocoa plants?
Yes, you do. Thank you.
By fleas on the backs of wild boars. No, again, I'm not making that in really. First American Financial Corporation, ticker symbol FAF. Those shares could come under pressure. They're in the business of providing title insurance, but the top U.S. consumer watchdog, the Consumer Financial Protection Bureau, considering whether to bar mortgage bankers from charging home buyers for title insurance. If approved, it may offer at least some relief to Americans struggling to purchase affordable homes. And remember, essentially, what title insurance is, it's protection for the lender, not for you. So why are you paying for it? And for the first time at the U.S. Brewers Cup competition, a competition that highlights the craft of filter coffee brewing by hand, the winner is a decaf. Decaf has long been the subject of derision and jokes within the coffee industry and out. I bet they're a real laugh, but it's quietly continued to grow in both quality and popularity. SkyQuest Technology predicts that the decaf market will grow to $28.86 billion by the end of the decade. And that's your company news.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Wednesday, everybody. We made it to Hump Day. Happy post-CPI moment. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio, where we bring you all our top analyst coverage all around the world. They cover 2,000 companies in 130 industries. We'll bring all their data to you. We also going to bring you world and national news with Michael Barr. Hey, Michael.
Hello, Alex, Paul, and John. The longtime chief financial officer for Donald Trump's real estate company was sentenced this morning to 5 months in jail for lying under oath during his testimony in the civil fraud lawsuit brought against the former president by New York's Attorney General. Alan Weisselberg pleaded guilty last month to 2 counts of perjury in connection with the suit. He admitted lying when he testified he had little knowledge of how Trump's Manhattan penthouse came to be valued on his financial statements at nearly 3 times its actual size. It will be Weisselberg's second time behind bars. The 76-year-old former CFO served 100 days last year for dodging taxes on $1.7 million in company perks. 2 weeks after the collapse of the Francis Scott Key Bridge in Baltimore, officials are setting the ambitious goal of reopening the entire port of Baltimore by the end of next month. Today, federal officials from Transportation, the Coast Guard, and the Army Corps of Engineers are expected to brief the House Transportation and Infrastructure Committee. Bloomberg's Amy Morris has the latest from Washington.
Closing the port of Baltimore has choked off exports of coal, with flows expected to plunge 35% this month. And while officials are pressing for the federal government to help foot the bill to rebuild and reopen, Maryland Senator Ben Cardin says the cost is still hard to pin down.
It depends on the design of the bridge, the modern technologies. There's been a 3,000% increase in the amount of cargo that since when this bridge was constructed.
Cardin did note that federal money did pay for the Minnesota bridge replacement, and any insurance and penalty payments in this case can reimburse the taxpayers. In Washington, Amy Morris, Bloomberg Radio.
President Joe Biden says Israeli Prime Minister Benjamin Netanyahu's approach to the war against Hamas is mistaken. Biden's remarks deepen an already growing rift between the two allies over the war, now in its 7th month. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg. Paul, Alex, John.
All right, thank you so much, Michael Barr. So here is a really fun study. Well, not if you're a meat lover, but according to a study over in the UK, if you swap red meat for small fish like anchovies, sardines, and herring, that could reduce global disease levels and save up to 750,000 lives a year by 2050. They point out in the UK alone, if you reduce red meat intake by 8%, replace it with these fish, that could prevent 10% of heart disease deaths in the next 26 years.
The small fish known as forage fish are rich in nutrients with low carbon footprint, although only about 26% of those caught are consumed by humans. There's a reason, dude. I mean, who eats anchovies? I know someone who eats anchovies.
So forage fish means the fish eat all the crap that floats to the bottom.
But if you eat that stuff, good for you.
What are they eating down there? I don't want to eat that.
But here's my question. Is it just, like, can you eat red meat and also just increase your intake of sardines and anchovies, or do you really need to do a switch?
Yeah, I don't know. I
don't think so.
Beef maybe once a week.
Right.
I mean, right?
Right. No,
So
I definitely don't. Maybe
At all?
once a month. Maybe once a month, yeah.
Okay.
When I need the iron, I think. But
As opposed to saying, boy, I'd like a nice steak tonight.
Well, but usually when I want the steak, it's because I need the iron.
No, you want the steak because it tastes good, and that's the whole thing about appetites and things like that.
Well, unless it comes with like a nice like peppercorn sauce.
Throw a couple of anchovies on your steak, and you'll be set.
Maybe that. I mean, or maybe you can mix anchovies in your burger, ground it up.
I don't think so.
No. Doesn't
Oh
work.
yeah, let's market
Plus
that one.
I mean, it could be good. I don't know.
It's the UK. They're always trying to think a little bit more
But the
healthy.
point is, it's funny because we take a look at the weight loss drugs, right? Like that could reduce heart disease, et cetera, as an offset to that. But what if you just sort of help to swap your diet on this end? Maybe that's okay.
Forget Wegovy. Have an anchovy.
Oh, man. That was brilliant.
Brilliantly
I'm
bad.
looking at him as if he's the smartest human being that I've ever met. That was amazing.
Brilliant.
So, no more beef, lamb, and pork. Go to your anchovies. All right, this is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, coming up, just want to flag in this hour, former Treasury Secretary Larry Summers is going to be on Bloomberg Television, and we're going to simulcast that around quarter past this hour as well. We're also going to check in with Jeffrey Cleveland, chief economist at Payton Regal, get his thoughts on this U.S. CPI print, much hotter than expected. The big take story out today from Bloomberg News, Joe Doe is going to join us. Bloomberg News metals and mining reporter on the column, Japan's U.S. steel takeover creates election year firestorm. I thought that deal was going to get done, but maybe the unions are going to step in here. We'll get the latest on that. But first, let's go to John Tucker and get a Bloomberg Business Flash. John.
All right, Alex posed the question a little earlier. Do you buy the dip? Well, looks like some investors are doing just that. Major stock averages, they are lower, but pairing some of the earlier losses after the CPI flashed hotter than expected. Stocks sold off, and of course, yields surged. We've been talking about that. We'll start with the policy reactive 2-year yield. Right now, it's up 18 basis points. It was over 20 earlier. Right now, the yield 4.92%. Well, the idea is that the Fed may not cut rates as much as possible right now after that hotter than expected report. The Fed should hold off on rate cuts for now, at least according to Robert Tipp. He's over at PGIM.
But I think there's pretty good reason for them to remain on hold here, see how things go. I will, remind everybody, of course, prior to the most recent few months, we had 6 months of really good inflation prints that were down in the target zone. So this could be a fluke.
Well, the S&P 500 right now, 50 points lower, down about 1%, just under 1%, 51.59 in the index. The Dow Jones Industrial Average, 411 points lower, that's down 1%. The NASDAQ 100 right now, 204 points lower, that is down 1.1%. Best performing stock in the S&P 500 right now, Axon Enterprise, their price target raised to $400 at Needham. This is a public safety technology company. And then Deckers Outdoor, the footwear company, they make Uggs. That's the worst performing stock in the S&P 500 right now, down 6%. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Paul and Alex.
Don't like Uggs, do you?
Ugg, the appropriately named Ugg.
I love Uggs.
Really?
Are Uggs still a thing?
I don't wear them. I can't wear them because of my feet, but man, I just love them.
Because your feet.
I have weird arches, so I can only wear orthopedics or heels.
You don't have to go public with all this.
I'm an open book. I don't know. I feel like unless we talk about this, but I do like Uggs.
Are they still a thing? Like they were for a while there. They were like every.
I don't know if they're that much of a thing as Deckers
like
will
Crocs.
tell you.
The Crocs were a thing.
No, we like the Crocs.
They're coming back, or I don't know.
Crocs are a thing. They're coming back. The company got an upgrade. Anyway, Uggs apparently, to Samantha, who's cooler than all of us, tells us that Uggs came back.
Uggs came back.
All right, let's get to more of the markets here. It does feel like we're buying some kind of a dip. We're just off the lows, and that's something. Abigail Doolittle is joining us for more. Abigail, what do you make so far?
I think it's too early to say that we're necessarily buying the dip. You have the S&P 500 down 1%. It is off of the pre-market lows of down 1.5%, but the actual market lows, it's about, 0.25% away from that. So we have to go through the day and see a little bit more. When it was down about 0.6%, yes, it felt that way just a little bit. And yields off the highs, but nonetheless, the 2-year yield backing up, as John Tucker was just talking about 19 basis points. That's still the biggest backup since the Silicon Valley crisis. blow up. So I think what stands out to me about that is that in terms of the inflation monitoring, we've had a few hot reports. Today's CPI report for March, I don't even know that you call it hot. I mean, it's slightly warm, but it supports the idea that inflation.
I saw that on Twitter, or I saw your comments calling it warm, and I said, that's right. It's definitely a warm one. It's not a hot one.
Yeah, and it confirms the idea, though, that inflation is stickier than people had expected and that the Fed won't be able to cut quite so much. So bond traders have been on top of this already. You had yields up a lot into this report, but really course correcting. And now the big question is, are we going to see a continued repricing of risk for stocks on the idea that the Fed might be cutting twice at most this year?
Have you heard people talking about in the market and the technicians, like no cuts at all, like maybe even a hike, for example, and like how you position around that, what the technicals look like around something like that?
I've seen a few people on social media talking about that, and of course, like Torsten Slok and some other people along those lines talking about that. And some people are even talking about the fact that this might even be what you just said, that the Fed could actually, that the next move will be a hike as opposed to a cut. What that would look like for stocks is really a breakdown to some degree, and we're seeing that for the NASDAQ 100 just a little bit. I'm going to pull up that chart. Last time I looked, it was hugging the 50-day moving average. I think right now it's probably below that 50-day moving average. Still hugging it, but close to breaking it. If the 50-day moving average on the NASDAQ 100 snaps, it's going to confirm that the year-to-date uptrend and really the trend out of the October lows is breaking. That just tells you that those buyers, are disappearing. The sellers are coming into play. And that could mean a move down to the 200-day moving average. Basically a fancy way of saying some consolidation ahead. Again, as traders reposition after having done well with the risk rally, reposition for a period of the idea of higher inflation for longer.
I like the Bloomberg headline here on the terminal. U.S. inflation refuses to bend. Fanning fears it will get stuck. And
yes,
I think
very colorful.
It's very kind of describes what's happening out there. What kind of, just historically, Abigail, what kind of a pullback, or as the kids call it, a drawdown, would be healthy for this broader market?
Feels like anything at this point that was more than 1%.
Right now, this current pullback, and when I say this current pullback, I'm talking about from March 21st, because we have been in a downtrend since then for the NASDAQ 100. It is a healthy pullback because we are consolidating onto that 50-day moving average. What would be truly helpful for the long-term buyers would be, oh God, it's just, gosh, I should say, it's just ugly. I mean, you'd really want to see,
is it 5%, 10%, that kind of thing?
It would be much more than that, actually. That's how far out. I would say on the NASDAQ, to feel good about it, you'd want to see it around 15,000 or so.
No interest there. Yeah, no interest in that. Yeah, no interest.
Which, if that were to happen, that would suggest the yields in the dollar are just going sharply higher, and the dollar for the wrong reason.
Right.
Oh, okay.
Well, I'm not saying that is going to happen. I'm just saying that's where support really kicks in.
And put in my order for a nice maybe 5, 6, 7% orderly drawdown. Sell off as we said.
So if you get a 5% drawdown from here, I think that is going to equal the 100-day moving average. Actually, I'm just going to pull up very quickly how much we are, because we might actually. So we're down 3% from the high. So another
double that and we'll be fine. Okay.
Yeah.
Yeah. 7% is going to be the minimum, I would say.
And you look at the S&P and the 50-day moving average, about 5,100. Nice, round number there, 60 points away, which just goes back to the buy the dip point. Like, clearly, yes, we're rolling over again, but we're off the lows, and at some point, you're going to want to get in, right? I was interested that Goldman Sachs Asset Management said, though, it's time to trim tech a little bit. Not that they don't believe in it, but just that the valuations have gotten so high. They like energy, they're overweight, and they're overweight Japan. You just have to wonder how many more of these
Japan?
calls.
God, that's amazing how that's
Warren
changed.
Buffett plus.
I know. It just out of nowhere. Abigail Doolittle, thank you so much for joining us. Abigail Doolittle, she covers all the markets for Bloomberg. Again, I just kind of go back to the story. Back in the 80s, you had to be in China. You had to be in Japan. That was the second. It was New York, Tokyo, and then London.
Interesting.
Yeah, and then that was that for like 15 minutes. And then starting in the 90s, you'd never even talked about it until a year ago when Warren Buffett and some others started talking about Japan again. And I'm like, oh, yeah, maybe we need to go back there.
Which is what's so interesting, too, because if you get any sustained move in the yen, and that obviously feels very far from truth at 152 for dollar yen, but if you get something like that, does that actually wind up denting the stock market?
Yep.
And then how you just trade that off?
All right, let's check in with one of our favorite economists. We like to talk about macro stuff with Jeffrey Cleveland. He's the chief economist at Payton and Regal. He's in that little hamlet out west called Los Angeles. Jeffrey, thanks so much for joining us here. Boy, the kind of looking at what's happened in the financial markets here today, I don't think they were discounting this kind of inflation print. What did you make about the CPI?
Well, someone said Uggs earlier, and I just thought ugly. That's all I could think about. Yeah, I mean, so I think, as I always say, context matters for markets. And the context going into this number was that January was a fluke and February was a bump in the road and things were going to settle down. And this morning's number, core CPI in particular, at another 0.4. That tells me it's more than just a fluke. A colleague just texted me and said, what's the technical definition of a trend? And I said, 3 months. 3 months is a trend. And so I think we have a trend here of stickier inflation. And that's what's playing out. And you could say now the 2-year yield maybe is more fairly priced than it was certainly at the start of the year. But we still have a couple of rate cuts priced in. So there might be more room for repricing here still, even after today's number. Yes.
Do you believe that there'll be 2 cuts, or do you think we could be in a situation where we're talking hikes in the next couple months, or are we talking about no cuts?
Last week I said June was off the table. I felt a little nervous about that until we saw this number. So I think June is off. And then I think you have to really wonder about July. And then September is tough for me. I'm not saying the Fed is political. I'm just saying, do you really want to start a cutting or an easing, or to even do just one right before an election? I think, if the data justified it, maybe, but if there's any question mark, you wait. So I think that should really the market should be reducing the probability of that September cut as well. So everything I think is just going to get pushed out. It's possible we only get one, and that would be contingent upon a second half that looks more like last year's second half. Which could happen here. I don't want to get too caught up in the inflation mania at the moment, too emotional about it, but it's entirely possible that we could run the year without getting a cut at this point. I think that's a likely scenario that investors should consider.
Jeffrey, how about just kind of the economic call here, soft landing, no landing? How do you kind of think this economy's behaving right now?
I heard hot landing.
Hot landing?
Yeah, I don't really know what that is, but I heard about that today.
Okay.
So we've been sort of operating with the no landing. It would be an acceleration in GDP, an acceleration in inflation, a new low in the unemployment rate. We're not quite in that scenario yet. Maybe that's more the hot landing scenario. Then we said, okay, sticky inflation. That's where inflation on core CPI hangs out. I don't know, 3 to 4%, somewhere in that range on a year-on-year basis. Good growth, above trend growth. The unemployment rate stays low. So it feels like that's the scenario we're in. We're in the sticky inflation scenario. The soft landing is if you need to see a further moderation in inflation. So at present, we're not in